very long time forward. People are saying, I want to know now, and that's basically what's going on in markets.
Equity futures down about 0.1%. Later this week, you can wait for this, earnings from Apple coming up on Thursday. Sources telling Bloomberg, Apple's iPhone exports from India jumped by a third in the 6 months through September. The numbers underscoring the company's efforts to expand manufacturing in India and reduce dependence on China. And China's going to be a huge feature of earnings season this week for the tech players.
This, to me, is a fascinating story at a time where Tim Cook is top diplomat to China from the United States, talking about how he's committed to China, doing tours of people who are buying iPhones in the mainland, and yet still stealthily moving production to India with the question of, A, is that going to be the next growth engine? But B, how do we sort of diversify away from China should there be another problem? And that is what we're seeing. Look what they do, not necessarily what they say.
Apple, one of 5 Mag 7 companies reporting earnings through the week. Google, coming up after the closing bout today. The company expected to post strong revenue and profit growth driven by the cloud computing division and internet search business. Mandeep Singh of Bloomberg Intelligence is with us around the table. Mandeep, good morning.
Morning.
Alphabet at the start of this year, existential crisis, not in the AI game. They're going to be disrupted. And here we are up 20%. What went right?
Well, clearly they have released, their own large language model, and they have seen some traction. But I would say the expectations are still low. Everyone expects, ChatGPT to take away some of the search share from Google. And just overall, I would say in terms of sentiment, the sentiment is still somewhat neutral on Google compared to a Microsoft or, Apple for that matter. And that's where I think they can surprise to the upside, simply because, what they have done is not only on the search front, they've released the model, even on the chip front, when it comes to training these large language models, the next version, some say will cost $1 billion. Well, Google has their in-house chip to train these models, and I think that's where the advantage will become very obvious.
There has always been this regulatory burden on the horizon that is haunting these big tech firms. It feels like that burden is getting bigger and bigger. There's almost like this massive grey cloud now that they have to confront over the next 12 months. How very real is that threat?
I mean, it is, in terms of, the number of cases that are pending in the U.S., let alone, outside. And that's where they have to kind of restrain themselves from being very aggressive when it comes to tapping these markets. I mean, look, YouTube could easily expand into some other domains, but given how dominant it is, I think that's where the effect of regulation comes into play.
I just got to jump in. Are you saying this company is not going as aggressive as it could do? It's limiting its own growth because they're worried about what might happen in Washington?
Absolutely. I think it affects the perception. I mean, for a while, everyone thought, and for good reason, Google was the monopoly in search. Now, at least everyone believes there is a lot more competition coming from all these other players that are building search around large language models. So they are definitely not the first ones out there in terms of, adding another product or feature, because they are so dominant in the businesses they operate.
So which areas are you looking for signs that they're basically revving up their ability to expand should the environment be conducive to that? How much is it important for them to make a greater inroad into cloud computing, to be a real competitor with the likes of AWS and Azure?
Yeah, so that's where I think they have a lot more runway in terms of both, expanding as well as making acquisitions. But look, when it comes to cloud, even that is a segment with a long runway, simply because they have all the capabilities in-house. Even a Microsoft that is growing their $80 billion Azure revenue at, a 30% growth rate, they're dependent on OpenAI. In the case of Alphabet, they've got all the ingredients in-house, their own model, their own cloud infrastructure, they can deploy it. And that's a big, powerful advantage, because all these models, in the end, rely on proprietary data. You have to have technology to, train these models, and Google can do it all in-house. So that's where I feel the moat will become more obvious as we go along in terms of scaling these models. But right now, obviously, I think the regulatory pressure is limiting them in terms of how frequently they release new products.
Is there a particular company that they would want to buy if they could regulatorily?
So a security company, Wiz, was in the news. They were looking to acquire that, but Wiz turned down that offer, and it was a significant $23 billion offer that they were willing to make. So that's where they are looking to expand on the enterprise side, because they're so dominant on the consumer side. And that's where I think the from a regulatory perspective, they have fewer hurdles to overcome because at least they're not so dominant on the enterprise side.
So if they're so worried about policy out of Washington and regulatory concerns, is that why Sundar Pichai is calling up the former president and telling him his McDonald's stunt was a great hit on Google to have this check-in?
I mean, look, I think for all these big tech CEOs, what happens on November 5th does have a bearing on who is at the regulatory bodies and how these cases progress. And look, if there is one thing that is a big risk for Google is even a forced divestiture of one of their segments will have an impact. I mean, remember, Google's infrastructure is shared across all their businesses. Even Waymo could be a big business down the line. And it's all powered by one common infrastructure. So forced divestiture will have an impact.
But Mandeep, this is a change from leadership in Silicon Valley. They used to cloak themselves in this liberal view of the world that we're here for the greater good because they were worried about the threat from the left. Now they have to worry about the threat coming from the right as well. If you listen to Senator J.D. Vance and some of the things he says about big tech, these are capitalist individuals but are worried about the dominance of a select group of companies in America, and they're willing to do something about it based on the communication I've heard over the last 12 months. How are these tech firms shifting the balance down in Washington, D.C., the lobbying effort, their approach to these conversations, when all they used to have to worry about was the left, and now they need to worry about the right as well?
Yeah, look, I think they just have to show why, they need to be big in terms of developing this AI infrastructure. I mean, look, everyone out there is trying to develop artificial general intelligence. That's the end goal. And the way you do it is by investing in big infrastructure. That's the only way you can get to AGI. So they have to show it to the regulators and to everyone involved why, the scale is so important when it comes to developing this new technology.
Mandeep, it's good to see you. Massive week. No doubt we'll catch up again later this week. Thank you, sir. Mandeep Singh there of Bloomberg Intelligence. Alphabet earnings coming up after the closing bell. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Goldman Sachs CEO David Solomon is optimistic about the U.S. economy, saying his base case is for a soft landing. Solomon joined Bloomberg in Riyadh.
If you took a tour around the world, the U.S. economy is actually doing quite well. It's been very, very resilient. I'm a little bit more concerned about European growth and also the economic situation in China.
Solomon also said that Fed rate moves will be data dependent next year. Pfizer shares, those are jumping in the pre-market trade nearly 2%. They reported a third quarter estimate that topped estimates, rather. It also boosted its outlook for the full year, saying it was on track to deliver $5.5 billion in cost cuts. Pfizer will have been aiming to quiet critics with this report, coming under pressure from activist fund Starboard to find new hits in a post-COVID vaccine era. And it was the American sports fan favorite day of the year. Monday saw all four major U.S. sports in action, likely for the only day this year. The phenomenon is known as the sports equinox, and it's only happened 30 other times in history. A full slate of NBA and NHL games were happening at the same time as the Game 3 of the World Series and Monday Night Football. In the NFL, the Steelers took down the Giants to win their 22nd straight Monday night home game in a streak going all the way back to 1992. And that's your brief, John.
Tough 24 hours for New York sports, unless, of course, you're a Mets fan. Is that right, Lisa?
Hold on. No, hold on a second.
No, okay. All right, just correction incoming.
I'm actually rooting for good games, close games, close series. It's
you're
unfortunate
disappointed
when it's a
for different reasons.
Yeah, I think that it should be competitive.
Good
It's
hedge.
nice to see people actually work hard.
Good hedge. Did you hedge this? Crocs down hard in the pre-market and early trading, down by more than 10%. Investors not enthusiastic about the outlook from this company this morning.
Seeing revenue at the lower end, about up 3% versus the estimate of seeing somewhere between 3 and 5%. A real question, revenue for Hey Dude, down about 14.5%. That was on the figure end. You're laughing. I mean, maybe it's the, high heel Crocs that people are looking at right now. Or maybe they're not cool with the kids anymore and the little sticky things that they put in the holes. I don't know. I know that Anne-Marie was a big Crocs fan, but now I heard that she's kind of moving away from
I'm definitely not a big Crocs fan, but my nephews are.
Okay.
Kids love them, like little kids. They call them slip-on shoes, and they think it's so fun.
Because they don't have to learn to do the shoelaces.
Because they're slip-on.
Yeah, precisely.
Sorry, this is sort of the truth. I mean,
Not
they're
my
practical.
thing. I can't
No,
help.
and the little Pokemon.
Exactly,
all
the
the
little
fun.
stamps. Look, but I think that they're losing their appeal. I think
The
that there are other
charms.
things. I'm just saying.
Stock is down by 10%. Enough said. Up next on the program, sounding the alarm on policy risk.
Trump policies will lead to more inflation, larger deficits, lower economic growth, and enormous amount of disruption in the short run.
That conversation up next. The former World Bank president, David Malpass, just after this commercial break.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Equity futures on the S&P just a touch softer. We're down by 0.1%. Under surveillance this morning, sounding the alarm on policy risk.
There is no comparison between the economic policies of Trump and those of Harris. Trump policies will lead to more inflation, larger deficits, lower economic growth, and enormous amount of disruption in the short run. He has such control of his party. If there were a Republican Congress, those cuts might be put into place.
So here's the latest. Economists debating the impacts of Trump and Harris policies on the U.S. economy. Both Harris and Trump projected to add trillions to the U.S. deficit, with many experts cautioning against the effects of Trump's vast tariff proposals. Joining us around the table, the World Bank President, David Malpass, the former World Bank President, David Malpass. Good to see you, sir.
Hi, Dan. Good.
Fantastic to catch up, as always. David, as you know, there is a massive difference between a campaign promise and legislative reality. How big is the gap between the two right now, given the campaigning that you've seen?
It's huge. So the campaigns are both promising the air in the sea, but as Washington gets at things, this is how Washington got to be huge. They chew up policies. And so one of the things is to be very clear about what policies are the most important. One from Trump is that we need to produce more energy and fix the grid so that there can be more growth within the economy. So just full stop, Can you do that? Well, that's really hard to do. Same on the taxes. The tax code is really fouled up. It doesn't do what people are trying to get it to do. Can it be changed? Well, that's really hard. And so people need to recognize, I call it an upheaval, the need for upheaval in budget policy, in monetary policy, in regulatory policy. That's hard to do.
What kind of upheaval? Because, well, first off, you talk about energy. Right now, the Biden administration is producing more energy than under any administration ever. But what kind of upheaval? Elon Musk the other day talked about $2 trillion can be shaved off. Where?
When you say energy growth, you have to go against what baseline? So could the U.S. be producing a lot more energy? And the answer is very clearly yes. One of the problems is in the Permian Basin, which is this remarkable field in Texas that they keep saying is exhausted, but it keeps producing world record amounts, doesn't have the pipelines to get the energy from the fields into the cities and around the world where it's needed. You know, Texas is producing this giant amount of energy for the rest of the world because they're behind as well. On the $2 trillion, every part of the government can be done more efficiently. Plus, look at what Harris is talking about, a giant growth in government. The CBO forecasts right now have us going from $6.3 trillion this year all the way to I think it's 10.3 trillion. So it's the most massive growth planned for the U.S. government that anyone's seen.
But
can that be cut back? Yes.
But David, unless the Trump campaign and potential administration is willing to cut in Social Security and Medicare, where are we saving them? Even if Trump fired, which I know he loves that word, every single federal employee, you only save some $300 billion. Where is this $2 trillion coming from?
But think what I said, we're going from 6 trillion to 10 trillion plus on both sides. If you went to 8, you would have cut 2 in quote cut, which means slower growth. You can do it that way. But I think there's direct ways. People across the country know of government programs that shouldn't be there. Federal government is subsidizing everything. And so that can be cut without it really harming. Think what happens if you don't employ the person as a government worker, a federal government worker. They are allowed then to work in the private sector, or they will end up working in the private sector. They'll be more productive. They'll actually get stuff done. So the government is crowding out private sector business all the time.
Just quickly here, how much are we seeing this getting priced into the Treasury market? How much is this what you see as behind some of the increase in longer-term yields?
We were at 0% rates for a long time. That I think it just is taking markets a long time to figure out what is a neutral rate. And that does depend on what your policies are going to be. So if you're going to have a weak dollar policy, as it seems as if Biden and Harris have had, then that means you're going to have higher interest rates. If you have the dollar as a reserve currency, the yield curve can be lower, and you can do it from both the short end and keep the increases away from the long end. So I think markets are really responding to where they think the policies are going to be. Now the positive side is if you say something sensible today, the markets will price it in today. They won't wait for that out into the future.
If you say something sensible today, you probably won't win next week, and that's kind of the problem. David, it's good to see you. Thank you, sir. David Malpass, the former World Bank president, on the difference between a campaign promise and the reality of getting things done down in Washington, D.C. Up next on this program, we'll catch up with Tom Becker of BlackRock, John Murthy of Bank of America, Lydia Basur of EY, and Mona Mahajan of Edward Jones. As we count you down to the opening bell, about 94 minutes away, equity futures on the S&P 500 slightly softer. We're down 0.1%. The third hour of Bloomberg Surveillance up next.
Like, let's say somebody is an Uber or Lyft driver today, where they can actually sort of manage a fleet of cars, and manage, I don't know, 10, 20 cars, and just sort of take care of them like a shepherd tends their flock. You have your flock of cars, and you're the shepherd, and you take care of your flock of cars. I think that'd be pretty cool. I think it's going to be a glorious future. It's going to be really something special. So, yes, good, all excellent questions. We do expect actually to start fully autonomous, unsupervised FSD in Texas and California next year. And that's obviously, that's with the Model 3 and Model Y. And then we expect to be in production with the Cybercab, which is really highly optimized for autonomous transport in probably, well, I tend to be a little optimistic with timeframes, but in 2026. So, yeah, before 2027. Let me put it that way. We'll make this vehicle in very high volume, but well before that, you will experience a robotic taxi via the Model 3 and Model Y program, and Model S and X too. But your 3 and Y will achieve unsupervised full self-driving with permission in wherever regulators essentially approve it in the U.S. and then to follow in outside the U.S. So, and the Cybertruck too. Yes, of course. Sorry, I don't want to forget. Yes. All our cars are basically all cars that we make. So.
Artificial intelligence. Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
The street is even more bullish on Trump winning than the predictive markets are.
The most bullish for the dollar's a red wave.
Yields, I think, are moving higher based on the election.
To have a closely contested election would be very unsettling to the bond market.
I think inflation is due to notch higher, or at least stay stubbornly stuck where it is, no matter who wins.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes away from the opening bout, the third hour of Bloomberg Surveillance starts right now. Let's start with equities and then we'll move to bonds. Equity futures, your scores look like this on the S&P 500. Just a little bit softer so far this morning. Likewise on the NASDAQ, down a bit more on the Russell. The small caps negative by a third. Some new levels to talk about in the bond market. A 10-year through 430. Yields higher by 2 basis points and yields up again on a 2-year for a 7th consecutive session. We'll go through the day ahead, and then we'll get to the big three for the week ahead. The day ahead looks like this. We get some data later this morning. JOLTS job openings, 10 a.m. Eastern time. Don't miss that. Then after the bell, the first of 5 Mag 7 earnings reports this week. We'll hear from Alphabet after the close. Then the week ahead, the big three. Payrolls on Friday. And then next week on Tuesday, we're going to get an election result, I hope, Wednesday morning, potentially. Could be election week. And then after that, 2 days later after that, we're going to get a Federal Reserve meeting. Good luck to the FOMC.
Is this fun? Are you having fun yet? I love what Jason Draho said over at UBS. Exhilaration is not the first word that comes to mind when thinking about the election, maybe anticipation for some sort of certainty. It's about the election, it's about the Fed, especially at a time where you have those yields creeping higher. And that's why I think that is the main theme. Why have you seen this 68-point rise, basis point rise, in 10-year yields at a time where the Fed is still on track to cut rates? And that mystery, I think, is underpinning a lot of this uncertainty that we see in markets.
Depends who you ask, whether or not it's economics or this Trump trade that's being priced in. Jessica Taylor, sorry, Jonathan, Cook Political Report, talking about it may take days, at least for the presidential race, if it's that tight. That means maybe Friday, maybe Saturday, like 2020. So we can have a Fed sitting down 48 hours after a presidential election, not having an answer of what policy is going to look like going forward.
We've said it repeatedly on this program for months. We're flying blind into 2025, and it's hard to have conviction about absolutely anything. This just came in from a Bloomberg subscriber. The market seems to be clear on one thing and one thing only. The 50 basis point cut last month was the wrong move. And that individual's got some company.
You know, there is an increasing number of people saying that maybe the Fed will cut 2 more times this year, but after that could be on hold for quite a while because there is this better than expected data that's been coming up. You see the better than expected economic surprise index by Citigroup and Bloomberg. A question here, though. What is what we're seeing right now in the bond market? Is it a Trump trade? Is it that it was a mistake? Are we seeing inflation expectations absolutely skyrocket? Not really. If you look at the break-even rates, they are creeping higher, but there is something else afoot, and we're seeing it in auctions, and we're seeing it with the deficit, and I think that that is something we got to keep focusing on.
Soft auctions, I'm told, in the last 24 hours on 2s and on 5s as well. We get more this week.
$44 billion today, 7-year notes.
Look out for that a little bit later on this afternoon. Your 10-year at the moment this morning, 430, up 2 basis points on a session so far. Stacked hour coming up, so let's get to it. Tom Becker of BlackRock with stocks rising a week out from Election Day. We'll speak to John Murphy of Bank of America Securities on Ford's disappointing forecast and Mona Mahajan of Edward Jones on why the bull market is still intact. We begin this hour with bond yields climbing ahead of a week full of jobs data. With just 1 week to go until Election Day, BlackRock's Tom Becker saying we are positioned for a continuation of transatlantic growth and deficit divergences that should widen interest rate differentials between the US and Europe. Tom joins us now for more. Tom, good morning.
Morning, John.
Let's get to the why. What's the why behind that call?
Couple different aspects to it. I think last time we were on, we talked about kind of the no landing scenario in the U.S., and I think the conversation you're just having about the 50 basis point cut, subsequent revisions, data looking stronger, I think that's an aspect of it. But fiscal is another big aspect of this. So auctions haven't been digested that well. You've got the QRA yesterday, which came out kind of toward the end of the day. So this quarter, not so big, but the forecast for Q1, kind of the biggest Q1 on record, $800 and change billion. So we've had this kind of upward trajectory in kind of the amount of debt that the U.S. Bond auctions have to digest. And so what we see is that kind of puts upward pressure on yield. That money is actually crowding. Our view is that money's crowding in investment. So when you look at kind of where some of this deficit spending's going, it's going into structures, it's going into CHIPS Act recipients, it's going into Inflation Reduction Act recipients. That's bringing private capital into parts of the economy, helping to make it less interest rate sensitive, but also keeping nominal growth pretty high. And so I think we've seen this kind of upward revision in activity. We think kind of the deficits are helping to kind of keep the U.S. Looking stronger in the global cross-section.
This is a transatlantic call.
Yeah.
Give me the contrast, the difference between what's happening over in Europe.
Couldn't be more different, right? So here you've got companies kind of lining up to take the subsidies. In Germany, they're kind of saying, no thanks, we don't want to build our chip plant here. We don't need the subsidies. The news over the weekend kind of the layoffs in Volkswagen. So you're seeing a very different labor market. You're seeing consumers in Europe respond differently to that. Savings rates are up because precautionary savings, people don't feel as secure in their jobs. The investment is not flowing through and kind of keeping growth quite as high. And you've got things in the German constitution like the debt brake. Tomorrow, big day for the UK. We've got Ms. Reeves coming out with her budget. The last couple months, gilt markets have definitely been concerned about a repeat of the 2022 mini budget event. So that's been putting upward pressure on global yields. But we think that's pretty transitory here. We think kind of the growth, the inflation in Europe we think the likelihood of them, making the same mistake twice actually unlocks some value in UK yields, and then German yields we think should just come down on the weaker growth, the weaker inflation.
We're already looking at about 2 percentage points of a gap between German 10-year yields and U.S. 10-year yields, and you're talking about even greater widening out.
Yeah.
At the same time, where the ECB has to explain why they're not cutting rates more aggressively, and the Federal Reserve has to explain why they're going to keep cutting rates. Right. And this is sort of the divergence that you're talking about. So from BlackRock's perspective, from your portfolio, is this a long dollar and long U.S. bonds or short U.S. bonds? Is it long dollar and long European debt? Because that's going to benefit from this whole trade.
Yeah, Lisa. So in the portfolios we run, their macro portfolio. So we're trying to time asset classes and countries. We think this fiscal dominance is going to pervade asset classes. So we think about the themes that are going to kind of be impactful for FX markets and bond markets and equity markets. And we think we're in a fiscally dominant environment here. We think that's actually going to put downward pressure on the dollar. So we've got a big election next week. Tariffs are definitely going to shift the kind of winds on that. But we think kind of quarter after quarter, kind of the amount of issuance that's coming into the markets, the U.S. needs foreign bond buyers to step in and be the marginal buyer. And so we think over time, the amount of issuance coming in the U.S. should weaken the dollar. So position for a weaker dollar on the issuance, but then a widening of kind of long-term yields because of the amount of duration that Janet Yellen's putting into the market with kind of quarter after quarter of higher bond issuance.
Is this basically the U.S. losing its mantle of exceptionalism, or is this the idea that the dollar can weaken, but still the U.S. economy can grow at such a pace that it still is a place of equity outperformance?
So I think the latter is kind of how we would position. So prices will adjust, supply of bonds and kind of better growth and a Fed that maybe doesn't cut as much as the ECB. We think that can keep the divergence on yields moving wider. But we think, with the backdrop that we have stateside, the growth can kind of continue with kind of strong consumers, strong reindustrialization policy. We think the tailwinds are kind of structural, but the prices still need to adjust wider. So we need kind of higher yields to tamp down on activity. So the yield curve only just uninverted recently. That's a very strange situation to have kind of for as long as we've had it. Those low yields at the long end encourage investment. They make the return, there are more NPV positive investments out there when you've got 10, 20, 30-year financing at that low rate. So we think this kind of, the higher yields should put a natural damper on activity, which would benefit kind of the Fed and kind of the whole U.S. backdrop.
Tom, you mentioned the Treasury Secretary and her debt issuance. Don't you see that level of debt issuance continuing regardless of who gets in the White House?
So a lot of it's structural. So entitlements are indexed. You've got CHIPS and IRA, which have multi-year kind of progression into the markets. So yeah, I think kind of we're in a structurally higher deficit environment. And I think that's juxtaposed against Europe, which is talking about tax hikes, talking about ways to balance the budget. I mean, the conversations just couldn't be more different when you kind of look at what Reeves is dealing with some of these nuances around, PS, NFL. Like, they're talking about the nitty gritty of the deficit. In the U.S., it's kind of like, is it big or is it really big? So the kind of conversation about, can we raise revenue? Do we have a kind of a home base on how big the deficit should be? 6+% deficits with this amount of economic activity is kind of unprecedented for the U.S.
How much harder is European leaders' jobs going to be if it is the former president and he puts up the tariff walls?
I think the responses to tariffs would be a big one. But I think markets have had time to adapt. Leaders have had time to kind of think through what is our policy in this new environment. And so, we're gonna take that when we're gonna cross that bridge when we get to it. But from here, we think kind of the backdrop is one where leaders are really looking to kind of keep growth going in the U.S., but in Europe, kind of keep bond markets kind of satisfied.
My bet would be that if we get those tariffs, your trade on long European bonds duration works even better, doesn't it?
I mean, to the extent that they're much more of an export-driven economy, I think it could hit them. So if you think about the German economy, they've kind of levered themselves to exports, kind of a neo-mercantilist type of setup for the last 2 decades. And global trade hasn't been growing as quickly.
Yeah.
You've got kind of companies and countries looking to do more closer to home. And so that's a tough backdrop for countries like Germany, like China, that kind of want to grow through exports. Whereas in the U.S. now, we're kind of growing with domestic demand and domestic production.
Speaks to the divergence that you'd be expecting. You said something that I want to pick up on and kind of finish there. You said that high yields might help the Federal Reserve. Is that an odd thing to say, to think about when they just cut 50 basis points last month?
So I think the Fed controls the front end of the yield curve through policy rates.
Yeah.
But they still have skin in the game with their balance sheet. And earlier this year, Waller spoke about kind of the composition of the balance sheet for the first time. Something we were thinking about, we called it QT Light. This kind of QT2 that they've done, they haven't sold quite as much duration back into the market as they did during QT1. And part of that means they're kind of holding on to more of these long-dated, 10-year equivalent bonds on their portfolio. Lori Logan spoke a couple weeks ago, very important speech. She's kind of on point for kind of the balance sheet. Usually she talks about liabilities. She mentioned, our asset side looks a little long compared to kind of, where the issuance is. We're going to have a conversation about this. And so I think kind of there's a potential that the bond market is also looking forward to maybe some of the compositional changes that might impact kind of long-dated yields versus policy rates.
Is there a conflict in that? Aren't we meant to be unlocking the housing market? Is there a conflict there between the goals of managing the front end and doing something about the long end?
I think the inflation target and the unemployment rate are Jay's pretty clear about that. He got asked at the last press conference, what do you think mortgage rates are going to do? He said, he didn't really have a great answer on it. But there's treasury rates and then there's spreads, and so you could see a situation potentially where if the yield curve gets more upward sloping, it gets more attractive to issue mortgages. So the spread versus the kind of risk-free rate is something to think about. But you've got a lot of kind of short inventory, a lot of demand in housing. There are other factors besides just the yield. And so I think it's important to just think through the totality of kind of the economic backdrop and not fixate on individual sectors or individual parts of the economy. It's so big and diversified.
This was really thoughtful. It's good to see you, as always, sir. Appreciate it. Tom Becker there of BlackRock, looking for increased divergence, transatlantic divergence on deficits and on growth as well. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Israeli Prime Minister Benjamin Netanyahu says he's open to a short truce in the war with Hamas. Egypt proposed a 2-day ceasefire and the freeing of 4 hostages in exchange for Palestinians held in Israeli prisons. Netanyahu said he hadn't formally received a proposal, but said he's willing to agree to such a deal if offered. Apple's iPhone exports from India jumped by 1/3 in the 6 months through September. People familiar tell us that the U.S. tech giants exported nearly $6 billion of India-made iPhones. That puts annual exports on track to surpass the about $10 billion of fiscal 2024. India is a crucial part of Apple's efforts to lessen its reliance on China, where risks have been growing alongside Beijing's tensions with the U.S. JetBlue shares, those are plunging 7.5% in the pre-market trade. Its loss for the third quarter was better than feared, but its forecast for the current quarter and the full year fell short. Cuts to flight capacity have failed to notably boost fares. The outlook also suggests that JetBlue's efforts to reduce expenses and boost revenue have been progressing slowly. And that's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, The Morning Calls Plus, we'll catch up with John Murphy of Bank of America as Ford lowers its full-year earnings forecast. That stock having a difficult morning. That conversation up next.
East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Equity futures on the S&P 500 just a little bit softer. We're down by 0.1%. Bond yields a bit higher, up 2 basis points. The 10-year, 4.30.43. Let's get you some morning calls. First up, TD Cowen downgrading Tapestry to hold, citing recent stock gains and worsening trends in China. Your second call from Jenny Montgomery Scott, upgrading First Solar to buy from neutral. The analyst saying a Trump win and tariffs would be a positive for long-term pricing. That stock is up by 0.5%. And finally, next up, Barclays raising its price target on Tesla to 235 and maintaining an equal weight rating, citing improving fundamentals. That stock just about unchanged after a mega run-up through last week. Sticking with autos, Ford lowering its full-year earnings forecast after reporting underwhelming 3Q results. Bank of America's John Murphy reiterating its buy rating, saying with a strong near-term product cadence combined with management's focus, we expect better profits and progress in 2025. John joins us now for more. John, welcome to the program, sir. Can we just start with the compare and contrast between what we heard from GM, what we heard from Tesla, and what we heard from Ford after the close yesterday?
Sure. Thanks for having me. So I think the real delta here, particularly versus GM, which is a more direct comp, is execution of Ford is okay, not necessarily great. We're still dealing with sort of the boogeyman of warranty issues, which they can't necessarily clear the decks on completely. And on the EV front, GM is probably about 2 years in front of Ford. So the improvement that we expect in EV losses at GM will probably be executed between 24 and 25 at GM, will probably be executed over the next 2 to 3 years at Ford. So those are the major differences. Sort of mid to long term, on the autonomous future, obviously, Tesla's making a lot of noise about this, and we think GM will on Cruise in the coming months and quarters. So on the AV side, there still is a void at Ford that needs to be filled. So there's a number of deltas here, but the truck platform, or the truck franchise, I should say, is still very strong at Ford.
John, can we just talk about the difficulties in the EV business? GM, of course, was a little bit more reluctant to lean into hybrids. Ford was less so. Where's that lean now? What does that look like? Where are they placing the emphasis of the company on where they want to be several years out?
So I think we have a much heavier lean into EVs at GM, obviously, with the Ultium platform. Ford is working on a Skunkworks platform, which is being worked on out of California by mostly non-auto folks, more in the tech world, which will address probably the small and mid crossover segments, as well as the small car segment to some degree. And I think Ford will continue to use a multi-propulsion strategy for trucks and large crossovers. So that puts them probably in the near term in a pretty good position in blue, which is quote unquote the ICE and hybrid business, but a little bit behind certainly on Model E, which is the EV side of the business.
John, will these results and the reaction that we've seen in the shares so far year to date really underperforming, going to push for more cuts at Ford?
Well, I think in the near term, all companies are very focused on cost cutting, and they have to do that to drive their core earnings and cash flow, not just for satisfying stock and investors in the short run, but also funding the future. I think as you look at this, there's a very significant difference in cap allocation between GM and Ford. And GM is very aggressively buying back stock right now. So in addition to reasonably better execution, you have a strategy that investors like more in the short term because the share count is shrinking in a flat, obviously, an earnings environment that can drive EPS growth, which is what investors really should focus on. At Ford, they're focusing on 40 to 50% of free cash flow being distributed to shareholders via the regular dividend and a supplemental dividend. Some folks don't necessarily love that. Some people do love that. It's a very different strategy as far as cap allocation. And Ford has also mentioned the idea that they may let cash build up a little bit on the balance sheet and not even fully distribute that 40 to 50% in the guise or sort of in response to a tough macro, an uncertain macro, as well as potentially organic investment opportunities, I think mostly around the pro and the service business, which has good profits and much higher returns than the rest of the business.
Ford might be underperforming GM, at least this year. But John, it still is looking fantastic compared to some of the European manufacturers. And I love your idea about just what is the distinguishing feature between the GMs and the Fords of the world versus the Stellantises and the VWs, why there is this growing divergence between the US and Europe. Is it the fact that the cost of labor is cheaper? Is it because Chinese cars are not really coming into US shores?
You know, I think on your earlier segment, there was a very interesting comment made about how Germany specifically had gotten intertwined with China, not just in the auto business, but in the industrial exports, whether machinery, tooling, and the like, even beyond autos. So I think there is a much higher safety level here in the U.S. market for the key franchise of GM and Ford around trucks than there is on the G3 or VW on their core European business, as well as the massive profits they've generated in China, which are now under pressure. So the D3, particularly I should say GM and Ford, really have not been as reliant on China as the rest of the industry, and they are more protected here at home. On Stellantis, they just got off sides on inventory and mix in their current dealer inventory, and that's been an issue that is been growing for the better part of the last 2 years. It helped them generate a lot of profits over the last few years, but now is a real weight right now.
John, you mentioned the warranty costs at the top of this segment. Why are they so high? Because the CEO said they're really not coming down as they would like them to be.
So there is warranty and sort of catch up on field service actions and other quality issues that are being executed beyond warranty, and they're really to make things right for the customer. So there has been quality issues in the past that are kind of sneaking up and popping up right now, as on sort of in the field, if you will. The current generation of vehicles is apparently much better quality than what's been going on for the last sort of 5 to 10 years, where these issues are arising. But it's very difficult for a management team to go deep into what is millions of units of vehicles on the road and really understand whether it is truly all clear. So I think that's sort of the sense of caution the management team has here, is to not sound the alarm that where things are all clear right now and you can really not worry about this past warranty or quality issues. But it is a major question. It is something that's coming up in the rest of the industry. Hyundai's got a big stop sale on Santa Fe's around powertrain. The Germans have a number of issues with brakes. GM's had some warranty issues that have popped up as well. And I think there's an overfocus, well, not an overfocus, but there's an increased focus on different kinds of powertrain and a whole lot more around AV. And a complex business has gotten just that much more complex. So the eye has been taken off the ball on some of these core quality issues. And I think it's a broader industry issue that seems to be more extreme before and probably is a little bit, but it's something we're going to be dealing with for a while. Good for dealers on the warranty side.
Well said, John. Appreciate it. John Murphy there of Bank of America. John, appreciate it. What has to be the toughest industry on planet Earth right now, right? I can't think of many others.
Especially given the uncertainty that we're talking about with policy, with the geopolitical trade relationships. And then, of course, there's the fact that consumers are a little bit fickle occasionally.
Bramo's decided to exit early, so you're not going to see Lisa for the next 30 minutes. She's going on assignment. Is that right?
I'm going to go check out the car dealerships and see
cool.
what the dynamic is going to be.
Lisa, thank you. Coming up next on the program, Lydia Vasseur of EY, Mona Mahajan of Edward Jones. As we look ahead to jobs data, we'll catch up with Michael McKee a little bit later.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
60 minutes away from the opening bell. Equity futures right now on the S&P slightly softer. We're down by a little more than 1/10%. On the Nasdaq, unchanged. Big afternoon coming up for the Nasdaq. Big week coming up for the Nasdaq 100 through this week. With 60 minutes until the cash open with your morning movers, let's cross over to Manus Cranny. Hey, Manus.
Jonathan, a very good morning. Yeah, those hyperscalers better not disappoint. Pfizer has essentially been living in the twilight zone. Life after COVID. Well, actually, COVID and their drug for COVID came into play. $2.7 billion for vaccines in this quarter. $442 million of an order from the strategic stockpile of the United States of America. So we're trying to grapple with, well, what is life for Pfizer after a major COVID vaccine rollout? It was about deals. It was about a $70 billion string of deals that they're doing. So they're going head-to-head with their activist investor, Starboard, at the moment to justify the $70 billion of deals and what they're doing with the R&D. They've raised the guidance $61 to $64 billion. And in that instance, we're up 1.14%. Up 4% for the year. Serial underperformer relative to the market. McDonald's, the Happy Meals, that is what you enjoyed in the third quarter, and you kept coming back for them. But international profits are down. Slippage on the net profit by about 3%. International sales, down by over 2%. So this does not include the E. coli incidences that we have at the moment. 75 people so far suffering from this, and a 7% drop in overall attendance at McDonald's. I can tell you this, the footfall is down nearly 10% in the past 7 days, 33% drop in Colorado, and in Wyoming down by 29%. You spent a lot of time on Ford, so I won't dwell, but I will put this to you. What does Jim Farley need to learn from Mary Barra in terms of executing on EVs? They are bleeding still on EVs. You spend time on this. They're going to lose $5 billion on EVs. It's going to be a 2-year transition until they make money. What else does Jim Farley need to do that Mary Barra has done, even as the combustion engine for them, Jonathan, slips on last year's numbers as well? Tough times at Ford.
Really tough times. Manus Cranny, thank you. A few stocks to watch going into the opening bout. Ford is down to the pre-market by more than 6%, close to 7% lower. Want to check out the bond market as well. Some new numbers for you on a 2-year and on a 10-year. The 2-year is up for a 7th consecutive session. We're up by 2 basis points to 4.16. On a 10-year, up by 3. Through 4.30, 4.31.64. The morning the Federal Reserve cut interest rates by 50 basis points, that 10-year opened at 3.64. We've had a move of more than 60 basis points. Mohamed El-Erian this morning on Bloomberg Opinion. The bond market has responded oddly to the Federal Reserve move. This is what he has to say, and I think this is a key line for us all to think about going into the next week. While most analysts agree on the list of potential contributors to this unusual development, there is little consensus on their relative importance. Which one is more important? The economic data, the deficit issues, the election, all of that still to come. We're going to work all of that out in the next week or so. Investors all need to work out this as well. The data this week with October payrolls dropping on Friday. Lydia Basura of EY saying the October jobs report will be muddied. 2 hurricanes and labor strikes will render the data much noisier than usual. We expect a non-farm payroll gain of only 70,000. 100,000. Lydia joins us now for more. Lydia, welcome to the program. When you look at that data when it drops on Friday, is one survey more reliable than the other, household versus establishment?
Good morning. So we're likely to see some hurricane impact, mostly in the establishment survey. We're looking for a drag on payrolls from both the hurricanes and strike. We already know from the BLS strike report that there is going to be 40,000 workers that are going to be falling off the payroll in October because they were on strike. And then if you layer on top of that the impact from the hurricanes, we're likely looking at a drag of over 100K on payrolls. Then you look at the household survey. The strikers are going to be counted as employed in the household survey, but we're going to be closely watching a few key indicators. You have to look at the number of workers that are not counted, that are not at work due to the weather, but are still counted as employed, and also temporary layoffs, which could show also some impact from those disruptions.
Lydia, how will you draw a distinction between what is temporary noise and what is cyclical weakness?
Yeah, it's going to be quite challenging to look at that. But, if you try to look beyond that noise, we've had job growth over the past 3 months, averaging 186,000. We think that the trend in job creation right now is likely around 175K. And we think that if you extract from that noise, you're likely to be, around that kind of trend pace in job growth. But the October jobs report and the November jobs report will carry that noise. So I think you'll have to rely also on other economic data. We're going to get the JOLTS data this morning, unemployment claims, and all the other labor market indicators that are pointing to a gentle slowdown in the labor market.
So does all the other data trump actually this non-farm payrolls report?
They're going to be complementing the data we're getting in the jobs report. We're going to be looking at the JOLTS data this morning and trying to gauge whether we continue to see that slowdown in labor demand, whether labor market churn also it has decreased significantly. So we'll be looking at the quits rate, the hiring rates, which have declined below their pre-pandemic pace. So I think all the data is important. We know that Fed officials are also closely watching anecdotal evidence, the data and the evidence from the Beige Book are also quite interesting. When you look at what we're hearing in terms of hiring, in terms of pricing power. So both the economic data and the anecdotal evidence are going to be important. Now, in terms of the Fed and how they're going to be looking at that jobs report, I think they're going to be looking through that noise, and we're expecting to see a 25 basis point rate cut in November based on the economic backdrop. Inflation continues to move in the right direction. And as I said, the labor market continues on that gentle slowdown.
You think we're going to get 70,000 jobs added to the market. What kind of number do you think would put the Fed on pause, even though you're expecting a 25 basis point cut?
Well, that's not our base case. I think, if you take a step back from every single data point and you look at the underlying fundamentals, I think there's still room for the Fed, to implement a few rate cuts from here. We have a labor market that has rebalanced, that's no longer putting upward pressure on wages. We have also inflation that's moving in the right direction. We'll get the inflation data this week, but there is more disinflation in the pipeline. We're expecting a moderation in economic activity as we head into 2025. We know that pricing power has come down. We're also hearing that in our conversation with clients. We also have more housing disinflation coming in. So if you look at that balance of risk with the inflation picture and the employment picture, I do think that the Fed will remain on track for easing and 25 basis point rate cuts at every meeting through the middle of next year.
Lydia, I just wonder what your thoughts are on the bond market action since the Federal Reserve reduced interest rates by 50 basis points. This big move higher we've seen in 10-year yields. What do you think that represents? What do you think is behind it?
Yeah, you've discussed on the show a lot of these factors that are behind this move. I do think that the upside surprise we've seen in the economic data over the past few weeks on the labor front, on the inflation front, a little bit more stickiness. And then on the economic front, with the upside, the upward revision to the personal income data, So all of that, the fact that we have a more favorable economic backdrop and a more positive growth picture, I think has been kind of a key factor behind some of the moves that we've seen in the bond market.
Lydia, appreciate it. It's good to hear from you. Lydia Basso there of EY, up 3 basis points now on a 2-year, 416 on 10s, close to 432. With us now is Mona Mahajan of Edward Jones. Mona, yields are higher, many people argue, for good reasons. For good news. We've had upside surprise after upside surprise from the economic data. And with that in mind, equities have held in there pretty well. Do you think we're entering into a zone where the 2-year above 410, the 10-year above 430 becomes a problem for stocks?
Yeah, look, John, thanks for having me. We do think some sectors in the stock market will face a little bit of headwinds because yields have been stubbornly high, despite the fact that the Fed is likely to embark on at least a modest rate cutting cycle here. And I think we've started to see a bit of that cyclical part of the market, the value part of the market, certainly interest rate sensitive sectors like real estate, even areas like utilities and parts of financials have started to move sideways and move lower because we've had this rapid move higher in the interest rate picture. I think for that broadening of market leadership theme to really play out, we needed to see a Fed rate cutting cycle, but yields moving lower, in addition to earnings growth expanding, which, by the way, we think that part of the story is intact.
Let's talk about the earnings then. Alphabet after the closing bell. How high is the bar for big tech? We'll hear from Alphabet and 4 of the other Mag 7 names through the week, with Apple as well on Thursday. Just how high is the bar for these names?
Yeah, look, the good news is mega cap tech has taken a breather for the last quarter and probably since the second half of this year. So the bar has been probably brought a little bit lower. And for Q3 overall, the expectation coming into the quarter was for a 4.1% growth rate. Now we're actually trending, and we're early days still, about a third of the companies have reported, but we're trending below that 4.1%. So it'll be interesting to see if tech is a driver of earnings growth and is the driver of the upside surprises we might get this quarter, or it continues to be in line with the rest of the market and numbers come in line and slightly below what we're expecting for Q3. But more broadly, we'd say tech, after taking such a breather, could actually be part of the basket that investors are looking for as we head into 2025. If the Fed rate cutting cycle is more shallow than expected, if yields are higher, it's still an area that provides outsized growth in an environment of high yields and potentially growth that is moderating the U.S. economy.
So if big tech doesn't clear this bar this week, do you think that could potentially be a buying opportunity?
Yeah, certainly we think after, the breather it's taken since the second half of the year, if we do start to get more volatility in this quarter, we do think, as we are headed towards that election day, we typically do see pre-election stock market volatility. We've seen it more in the bond market this time around. But if big tech does show, a volatility after earnings reports this quarter, we certainly think there could be opportunities there, especially if you perhaps haven't participated fully in your kind of AI tech part of your portfolio. We still continue to like that market broadening theme. And we think there's opportunities ahead, especially as this yield move has moved very far, very fast, and could provide some opportunities as well.
So this election impact and volatility, you say we're seeing it play out in the bond market. Do you think that the market is properly pricing in the U.S. election outcome and this idea of a Trump sweep?
I think certainly the yields, as many people have noted, have been a combination of factors. It's certainly that economic data has surprised nicely to the upside. And, this idea that we're getting a soft landing has almost transitioned to the idea that we're getting maybe no landing. Atlanta Fed GDP now is still looking at over 3% growth for this quarter. So certainly not even close to kind of that 1.5% to 2% trend growth. We're looking at an economy that is holding up quite well. And that in itself probably has sparked a repricing of the Fed rate cuts. We're seeing in the markets are now pricing in about a 3.75% terminal rate versus 3% just a few weeks ago. But the other part of the story, to your point, is we have an election on the horizon, and really either side of the aisle, neither of them have really taken a disciplined approach in terms of fiscal, reining in the deficits and fiscal spending, or on the tax side as well. So this idea that markets are pricing in deficits that may be creeping higher, grinding higher, in combination with an economy that's holding up quite well, is really leading to this move in the yield market, which is quite interesting and certainly having much more of an impact versus what we're seeing in a pretty steady equity market.
Mona, take a listen to this. It came from Ian Lincoln of BMO in the last 24 hours. He said, "We struggle to come up with a compelling reason to challenge the prudence of stepping back from high conviction trades, as the next 2 weeks could very easily redefine the macro narrative." Mona, do you believe that next week, and the election in particular, has the potential to redefine the macro environment, the macro narrative?
Yeah, look, enacting real policy change we know takes time. So despite the rhetoric, first of all, we think, checks and balances remain in place on whoever gets into that presidential seat. Probably that means some of the more extreme proposals are going to have more difficulty being passed. And so the real changes on the macro narrative will come around areas like taxes, perhaps on the tariff front, and maybe in terms of even immigration policy longer term. But again, these don't happen immediately. And so the near-term macro narrative will really still be driven by the fundamentals. Is the Fed cutting rates? Is inflation cooperating? And is the economy holding up? And the overall backdrop and the overall underpinnings of this bull market have really been a Fed that is cutting rates in an environment where we are not entering an imminent recession. And we know historically that has been good for stock markets and financial assets broadly. And we think, we've had a very strong run. The bull market's up almost 60% since October of 2022. Could we see a little bit of moderation in that pace? Absolutely. But we do think any periods of volatility we can still lean into because of those fundamentals that remain intact.
Certainly been bad for bonds, that's for sure, over the last month. Mona, appreciate your time as always. Mona Mahajan there of Edward Jones. Earlier on this morning, we had David Malpass, the former World Bank president, around the table with us. Asked him a very simple question to start that conversation. How much daylight is there? How big is the gap between campaign promises right now and legislative reality? And he just said one word: huge, huge. It's really hard to get some of the things done that they're promising on the campaign trail.
Well, if you want legislative promises that things you actually think can get done, that might not get you elected, which is why you have basically spaghetti thrown at the wall when it comes to potential tax cuts. Any sort of American might be able to see, whether it's no tax on tips or potentially no tax on Social Security benefits. Regardless, and I think Mona put this well, both camps will be spending more. And maybe that's what the bond market's picking up. Less so a Trump sweep, but just, It's an election, things are gonna be shaking up in Washington, D.C., and guess what? No one cares about the deficit.
That's one warning. Here's another. This came from Citi's Global Equity Strategy team just yesterday, I believe. Indicated that Trump trades have rallied. We're all aware of that. Long the dollar, short bonds, long the US versus the rest of the world in equities. And the recent price action implies a less favorable setup for Trump trades heading into November 5th. Goes on to say, with room for rotation should Harris prevail. And I've seen that last note from a few people on the south side over the last few days. That's for sure. Given this run-up we've seen in yields and the strength we've seen in the US dollar over the last month or so. Equity futures on the S&P 500 this morning, just a little bit softer going into the opening bell, about 44 minutes away. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Crocs shares falling 13% pre-market. The shoemaker said it expects 2024 sales to grow at 3%. That is at the low end of their prior guidance. Crocs had seen a resurgence in the last few years following a strategic move to target teens with endorsements from celebrities like Justin Bieber and Post Malone. But now the company has run into trouble in U.S. schools that are banning them due to safety concerns. The top prosecutor in Philadelphia is suing Elon Musk and his Trump super PAC. District Attorney Larry Krasner says Musk's daily $1 million giveaway is an illegal scheme to influence the election. The giveaway, which is already under scrutiny by the Justice Department, purports to randomly reward voters in 7 swing states who sign a petition from the PAC. Musk's allies have argued that the giveaway awards people for signing a petition, not for supporting Trump. The Dodgers are 1 game away from winning the World Series. They beat the Yankees 4-2 last night and take the 3-0 lead into tonight's Game 4 in the Bronx. If the Dodgers win tonight, it would be the first World Series sweep since 2012. The Yankees are hoping, though, to be the first team in baseball history to come back from a 3-0 deficit in the Fall Classic. And that's your brief, John.
Danny, thank you. Thanks for this morning, and thanks for that. Someone in the control room trolling Anne-Marie this morning. I think we've done that story 3 times.
Yeah.
Once every hour.
And why didn't we do 3 times when they were winning?
We gave updates, regular updates. What are you talking about?
It was once per the 3 hours.
Can you avoid the sweep?
I hope so.
Okay. How much cheaper are the tickets now?
The tickets are a lot cheaper. I'm considering going tonight.
All right. Up next on the program, we'll set you up the day ahead. We'll catch up with Mike McKee. Some really important jobs data coming a little bit later from New York. This is Bloomberg.
Many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
The opening bell is about 40 minutes away. Let's call it 39. Equity futures on the S&P down by 0.2%. Look at this move in bond yields. Up 4 basis points now, 432 on a US 10-year. Here's the trading diary, the calendar for the week ahead. Today, we'll get JOLTS data, job openings, plus Google earnings after the closing bell Wednesday. Initial GDP data and earnings from Meta and from Microsoft. On Thursday, a rate decision from the BOJ. And in the US, another round of jobless claims and core PCE, plus earnings from Apple, Amazon, and Intel. On Friday, October payrolls, plus PMI data. And on Monday, already looking ahead to Monday and next week, you'll get some durable goods data, but that's pointless to look at because you know what happens next week. It's election day, a week away. Then 2 days later, a Federal Reserve has got to somehow make a decision. Mike McKee's with us. He'll be in the room in that news conference. Mike, good morning to you. Can you imagine how many questions there'll be about the U.S. election that'll get ignored in that news conference?
I'll give you one question right now. 8:30 Friday morning, we get the jobs numbers. Will we know who the president is by the time we get the jobs numbers? That's, it'll still be hanging over everybody for days.
Without a doubt. Now, for you next week, this Friday, payrolls this Friday, then the election on Tuesday for the Federal Reserve 2 days later. How noisy is that data going to be from the payrolls data?
Well, there's a good chance that the payrolls data is pretty noisy because we've got the ongoing Boeing strike, and it's been on long enough now that it may spread to other industries, suppliers of Boeing, people who, have snack bars near Boeing, that kind of thing. And also, we have the hurricane issue. We don't know how many people are going to be out of work because of the 2 hurricanes. We saw a 1-week spike in jobless claims, and then it kind of went back down. So is it going to be bad or not? Bloomberg Economics thinks we could have a negative 10,000 print, and there is one estimate for 180,000 jobs created. I think probably the consensus of about 100,000, 110,000 is going to be the way to bet, but we just don't know.
What is, though, the possibility, the ramifications if we were to get a negative 10 print? That will certainly help out the Fed, but how bad is that going into a presidential election?
Well, I think you put your finger on it because it's not going to matter to the Fed. They will look through it. That'll be the headline number. The jobless claims number won't be affected by that. I mean, the unemployment rate won't be affected by that. So the question is, how do the headlines play it, and how do the campaigns play it? Obviously, you're going to see Donald Trump emphasize the weak job creation. You're going to see Kamala Harris emphasize the unemployment rate. Does it really get through to people in a way that will make a difference? Right now, everything that happens is being put through that lens of, does this make a difference in the election?
True. Plus, already 50 million Americans have already gone out and vote, and many of them will probably go out and vote even before we get that non-farm payrolls report. You say the Fed will look through a weak print. Can they look through a strong print?
Yes, because they're on a path to cut 25 anyway. So a strong print would probably just mean that they stick with 25. They don't do 50. And because this is coming in an unusual situation, November is probably going to remain on track. They won't have enough details about what happened in the jobs numbers, and we won't know who's going to be president. So they probably go with a 25 this time, and then December becomes the big question.
We've got about a minute left, which is a minute too long for some baseball wisdom from a Red Sox fan, if you're Anne-Marie. Do you want to share some?
Did you see the map of the country and who supports whom? It was like Southern California for the Dodgers and Massachusetts. and the Yankees had New York and Florida. So the rest of the country,
can they avoid a sweep?
Probably. Well, they could avoid a sweep, but can they win the World Series? That's going to be really tough. And as Red Sox fans would point out, only one team in a 7-game playoff has ever come back from 3-0.
Why are we ending on this? Who invited this rhetoric?
This is baseball wisdom. Knows more about the sport than I do, that's for sure. Michael McKee, thank you, sir. Appreciate it. Going to the game a little bit later, Anne-Marie with tickets on discount in the Bronx. 50% off? What's the discount look like?
The discount's pretty big. Not for right behind home plate. Those come a few thousand.
Let's start, just given what you mentioned, there was some news that came out in the 10Q this morning. It shows that Berkshire sold another 115 million shares of Apple in this last quarter. That's Berkshire's largest holding. And I think in that vein, we'll start with a question from Sherman Lamb. He is a 27-year-old Berkshire Hathaway Class B shareholder from Malaysia. And he asks, last year you mentioned Coca-Cola and American Express being Berkshire's 2 long-duration partial ownership positions. And you spent some time talking about the virtues of both these wonderful businesses in your recent shareholder letter. I noticed that you have excluded Apple from this group of businesses. Have you or your investment manager's views of the economics of Apple's business or its attractiveness as an investment changed since Berkshire first invested in 2016?
No, I would. But we have sold shares, and I would say that at the end of the year, I would think it extremely likely that Apple is the largest common stock holding we have now. One interesting thing is that Charlie and I looked at common stocks or marketable equities or the things that people love to look at as being businesses. And so when we own a Dairy Queen or we own whatever it may be, we look at that as a business. And when we own Coca-Cola, or American Express or Apple, we look at that as a business. Now, we can buy really wonderful companies in the market as businesses. We can't buy all of them. I mean, all of their shares. We can't buy 90% or 80% or anything like that. But when we look at Coca-Cola and American Express and Apple, we look at them as businesses. Now, there's differences in tax factors, there's difference in managerial responsibility, a whole bunch of things. But in terms of deploying your money, we always look at every stock as a business, and we have no attempt made to predict markets. We have no attempt made to pick stocks. I went through many years doing the wrong thing. I got interested in stocks very early, and I was fascinated by them. And I wasn't wasting my time because I was reading every book possible and everything else. But finally, I picked up a copy of The Intelligent Investor in Lincoln, and there was a few sentences in there that said much more eloquently than I can say it. But if you look at stocks as a business and treat the market as something that doesn't tell you, isn't there to instruct you, but it's there to serve you, you'll do a lot better over time than if you try to take charts and listen to people talk about moving averages and look at the Fed pronouncements and all of that sort of thing. And so that made a lot of sense to me then. And the way I've been allowed to deploy it, Charlie and I talked about this, of course, constantly. It's changed over the years as the amount of capital we have, and it's changed and all of that. But the basic principle was laid out by Ben Graham in that book, which I picked up for a couple of dollars, and which basically said to me, "You've been wasting your time now, but maybe you can use what you've learned or been reading about and put it to better use." And then Charlie came along and told me how to put it to even better use. And that's sort of the story of why we own American Express, which is a wonderful business. We own Coca-Cola, which is a wonderful business. And we own Apple, which is an even better business. And we will own, unless something really extraordinary happens, we will own Apple and American Express and Coca-Cola when Greg takes over this place. It's such a simple approach that it's almost deceptive. Most things, if you keep working harder and harder at it, you learn a little more math, or you learn a little more.
Jolts a little bit later. Also, consumer confidence. One of the most fascinating reads on consumer confidence that I've seen, our chart producer Dan Curtis put this together in London. The yellow line is millennials and Gen Xers, so heads of households between the ages of 34 and 54. They're not confident. In fact, the gap to their confidence and the confidence of 55-year-old heads of households is the biggest on record. So what's driving that? We'll talk about it later on in the program.
Had a knock on their door. Give them something to see the glass half full, Matthew. You always do. Now, with some stocks to watch under the surface, a lot of glass half full. Trump Media and Technology now up another 22% pre-market. Second double-digit day, of course. We had a big rise yesterday. McDonald's getting some relief as well. Now, sales fell short of expectations due to weakness in international markets, but the CEO says the E. coli outbreak appears contained. You see McDonald's now up about 1.5% pre-market. Pfizer up also about 1.5% nearly. They raised their guidance for the year in the first earnings report since activist investor Starboard entered the chat. And D.R. Horton, we're taking an eye on that as well. It has been a tough morning. The shares had been plunging after reporting weak home orders and high interest rates. We are going to keep an eye on that. It looks to be up pre-market now, about 0.6%. But of course, Matt, something fascinating about D.R. Horton here is you've seen mortgage rates up for the last month. So home builder stocks are high in focus for that reason, especially.
Dang. Wasn't D.R. Horton down 10% a little bit earlier?
Yeah, I don't know about that that board necessarily.
I see it down 14% right now.
I think that might have not been a pre-market board.
Yeah.
But
Right, the feelings under the surface here felt like they were down, and agreed they were down at least 12%.
Yeah, we'll remedy that. But in any case, we are in the thick of earnings season. The point being, of course, you showed 4 big movers in the pre-market, and it's interesting. You take a look at earnings calls so far. This was a fascinating note from Bank of America.
There's the actual.
There we go. Bad vibes.
McDonald's down 1.6% too. That's another one that didn't.
Yeah,
hold.
DJT, of course, kind of true to form. It's up another. I know.
After 20% yesterday, it's up another 18% today.
And as we discussed, it's not necessarily the social media sites' fundamentals that's driving the stock. It's just an election proxy. 7 days to go.
All right. Well, third quarter earnings season, as we've been talking about, really in high gear this week. Today, we're going to get the first of the Mag 7 big tech giants, Google parent Alphabet, set to report after the bell. Joining us now to talk about these big tech stocks is Stefan Slowinski, BNP Paribas Exane Global Head of Software Research. He has an outperform rating on Alphabet with a $210 price target. And let's just go through all of them, Stefan. First off, good morning.
Good morning, Matt. Thanks for having me.
Thank you for joining us. Let's talk about the AI investment, because that's what it's all about. With all of these stocks, well, at least Google, Amazon, Meta, Microsoft, what do you expect in terms of Google after the bell today?
So first of all, for all of these stocks, you're absolutely right. You know, investors are trying to look at any traction with Gen AI, whether it be in terms of data around adoption or usage. We're starting to get a lot of products live and ramp. AI overviews. Yesterday, Google talked about rolling out to 100 different countries. Apple Intelligence is now live, and even Meta AI may be used by over 1 billion people. So first of all, we're going to look at those data points around usage. Obviously, investors also want to see what's going to happen on the CapEx side. How are we going to pay for that usage? So any signals into 2025 on spend. And then more specifically for Alphabet, and to your question, I think it's an extremely important set of results. We have a new CFO, and we think that that's going to signal a change in communication practices from the company, which is super important because the company really needs to take control of its narrative.
It was bad and needs to be better, is what you're saying.
It's been challenging, and it needs to be better. And we've seen this new sense of urgency from Google, we think, has been underappreciated. One, in terms of product development and getting product to market fast. 2, in terms of efficiency, they've driven margins higher. And now 3, we think they need to improve on the communication front, and we think that's what the new CFO can do. So the surprise would be a Q4 guide, because currently they don't give guidance.
Yeah, okay, so definitely something to keep an eye on once we get those results. I'm looking at your notes. You talk about this Code Red initiative at Google following the launch of ChatGPT. You have to think that their core Google business has been challenged by these chatbots. And it's interesting, the information reported yesterday that Meta is actually developing its own AI search engine. It wants to lessen its reliance on Google. I mean, how hard is it for them to defend their search functions against chatbots?
Well, this is certainly where we're seeing that sense of urgency, right? Like I said, you know, with AI overviews now being pushed into 100 different countries and multiple different languages. So they're really accelerating those go-to-market motions around Gen AI and trying to keep people using the platform and drive adoption. But we're also seeing Google push on diversification. You know, don't forget 30% of revenues already come from enterprise cloud computing, from consumer subscriptions. So they're really trying to diversify that business model. And they still have 15 different surfaces with over 500 million users each. So they're accelerating that deployment of Gen AI across all of those services to drive adoption of those Gen AI usages.
We also have to talk about just valuation here, because it looks like there's been a pretty significant overhang when it comes to Alphabet, and the idea of any real antitrust concerns. Shares trading at 19 times earnings makes it the cheapest out of the Magnificent Seven. So even if they do come out with that guide...
That's worth repeating, I think. That's pretty crazy.
Incredible.
19 times earnings is the cheapest of all Mag 7 stocks.
Right, so how much upside is there, even if they do give the guide that you're talking about?
Yeah, so 18, 19 times earnings next year, that's a fully loaded number with stock comp, and you're right, that's about a 30 to 45% discount to a lot of those peers. Now, obviously, the DOJ overhang is there, and so investors need to assign some sort of discount for that. But once we get beyond that, obviously the core business continues to do well. Your question on search, the company should still be growing search and YouTube around 12%. And the rest of the business, we see Google Cloud beating expectations, growing above 30%. So when you look at even the free cash flow yield at around 4.5%, with the sector trading, below 4% free cash flow yield, you could see 20% upside here for Google, and yet still have a healthy discount to reflect that DOJ uncertainty.
By the way, does the DOJ, not to get too political here, does the DOJ still have teeth under Trump? If Trump wins, won't they be busy prosecuting the enemy within?
We'll see, but I think largely Google is not really viewed as a winner on election night either way, and so again, that's maybe a positive in the sense that that's already pricing in sort of any administration is not going to be favorable to Google. That's kind of the base case right now. So if that changes, then that could be upside.
All right, so a lot of focus on Alphabet, and deservedly so, of course, reporting after the bell. I do want to talk about Meta, because Meta has sort of been the shining star of the Magnificent Seven. You're neutral on Meta, I believe, and we had an interesting note from Peter Bukvar yesterday saying that the core business has been so solid that Meta has been able to weather this AI spend scrutiny. What do you make of Meta's core business at this juncture?
Yeah, so you're absolutely right. Meta's been a star. It's up 450% over the last 2 years off of those lows. We did actually initiate underperform in May. Part of the concern we have is it's still 99% advertising revenue. So whereas Microsoft, Amazon, Google, they've really diversified with enterprise revenue streams, consumer subscriptions. With Meta, it really all depends on them continuing to beat expectations in advertising. So they don't have the mechanisms just yet beyond advertising to monetize that Gen AI. The core business is doing well, but we're a little bit concerned about the Q4 guide, where you start to hit some headwinds in terms of Chinese e-commerce growth, in terms of the Reels year-over-year benefit, and also they may be taking away some investment in that core business to allocate to Gen AI, like the Llama model training or the Meta AI rollout, which won't generate revenues just yet. So that potentially could actually have a negative impact on the core business near term.
Now, how do you also think about Apple as well, just kind of in the news as well, this idea of Apple Intelligence and how long it will take to really feel the financial impact for that?
Yeah, I mean, I don't cover Apple personally, but clearly, like you said, they just launched that yesterday. And so we're starting to get these competing products in the market. What are consumers going to do? What are they going to use? Are they going to change their habits? Obviously, as we mentioned, Google's the one where there's the concern where people start to search elsewhere. But Google still has those advertising relationships, and they hope to still keep those monetizable searches, the valuable searches coming to the Google platform.
All right, that seems like a good place to leave it. Really appreciate the preview ahead of a big day, couple days of tech earnings. That, of course, is Stefan Slowinski of BNP Paribas Exane. Meanwhile, let's take a check on these markets right now. Not too much happening, you guys. You can see the S&P 500 down a little bit. Big tech really at a standstill on the NASDAQ 100, totally unchanged yesterday. And it was really interesting, of course, to hear Stefan bring up CapEx, because the CapEx spend and the forecasts, they matter for the names that are actually reporting, but they matter more for those hardware names that we're going to get. I'm talking about NVIDIA.
Did you see the chart I put in the chat just now? I mean, we talk about Facebook being the darling, and obviously Apple's done well, but if you look at a comp screen on the Bloomberg, over 5 years, NVIDIA just erases every other.
It's just not fair.
Yeah, no, it's up 2,683%.
It's like crypto levels.
By the way, we also have AMD aftermarket today, too.
Good
so
point.
It's a
Good
really
point.
good time to talk about those suppliers here.
Yeah, another chip maker coming out after the bell.
Yeah, of course, we're talking about hardware, we're talking about tech, but there's a lot moving underneath this market right now. Let's get a look at what's going on with Bloomberg's Jess Menton. Jess, take it away.
Well, looking at what some of the bigger movers are, I don't know how y'all feel about when it comes to sneakers and things like that, particularly maybe Matt. I know Matt likes the leather jackets, but looking at what's happening with the Vans owner, so VF Corp here, actually it was up almost 20% in pre-market trading, so it's actually rivaling some of its biggest move in years here. And so when it comes to, especially when it came to retailers, we've talked so much about the margin picture, and that's where it saw a lot of improvement moving forward. So you're looking at that up almost 20% ahead of the opening bell here. Yeah. So you're helping see, potentially keeping an eye on what it could mean for other retailers as well, particularly maybe in the shoe space too, as far as what those could be moving this morning, guys.
When we're talking about Vans, do you know who Jeff Spicoli is? Does anybody here know
No idea, Matt.
Jeff Spicoli?
I have no idea what you're talking about.
All right, let's move on.
Well, maybe not, maybe later in the show. Anyways, another one I'm watching near to me in the financial space, SoFi. I think this is kind of interesting. Not moving all that much. Maybe a sign of stability here. It usually moves closer to 9%. Now it's down about 2%.
Right. So looking at that, just ahead of the opening bell, like you mentioned, Shonali. So when you're thinking about this, that stock's actually up about 12% year to date through yesterday's close. But also when it came to this, it raised its profit guidance for the third time this year. And of course, we know a lot of it's, when you think about the company and its dependence on the student loan kind of lending type services, it's been able to expand beyond that. So that's why you've seen that. But also, even when you think about outside of this particular company, obviously, I know, Shonali, you cover the banks very closely, and especially when you're thinking about investments and that kind of as far as what it means for that. But a lot of those big banks, obviously, a lot of that came in stronger than expected. But when you're looking at the lending side of things, obviously, it already had a little bit of a bigger move year to date here. So that's probably why you're seeing that stock not making a bigger move, especially ahead of the opening bell.
You know, we're going to get, I think, Royal Caribbean. We're going to get.
Yeah, so
we got this morning.
Right, so that actually, if you're looking at what's happening with them, and that's important too, because actually hotel and cruise liners, if you look in the S&P 500 year to date, that segment in the S&P 500 is up about 12%, but Royal Caribbean, even ahead of these results, its stock was almost up 60% year to date. So obviously we know how so many of them had so many issues, especially in the aftermath of what happened with the pandemic. But unfortunately, its outlooks fell short of those expectations.
Can you tie them together with JetBlue? Because it's really not the same business,
well, no,
right?
it's not.
I guess you could say they're both travel stocks.
But
they're
also,
both vacation stocks.
Right, but also JetBlue recently was trying to move away from the business type clientele. And so that's something that their shareholders were looking very closely. But when you're looking at that stock as well, that one's coming under pressure because they didn't deliver as much as investors had wanted them to with this latest results this morning.
It's fascinating. Took a look at Norwegian, actually also down today. In synchrony, people are worried about how much people are traveling right now. Thank you just so very much. That is Bloomberg's Jess Menton all over what's happening under the market for us. And coming up, big tech reporting after the bell. We have been talking about it. We've already had some heavy hitters this morning. We're going to take a look at Pfizer's earnings beat next, see what's happening as they fend off an activist. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Let's get now to high interest to look at what's making headlines around the world. Boeing is raising $21 billion in an expanded share sale. It's one of the largest sales ever by a public company. The beleaguered airplane maker is shoring up its balance sheet as it seeks to stave off a potential credit rating downgrade to junk. The stock has plunged 42% this year. And Ken Griffin, the billionaire founder of Citadel, expects the race to the White House to be close, but he says Donald Trump will ultimately win. He spoke at a panel at Saudi Arabia's Future Investment Initiative Summit. Griffin is spending tens of millions of dollars to back Republican primary candidates across the U.S., but records show he has so far resisted contributing to Trump directly. And Apple's iPhone exports from India jumping by a third in the 6 months through September. The data underscores Apple's push to expand manufacturing in India and reduce its dependence on China. The tech giant is taking advantage of local subsidies, a skilled workforce, and advances in the country's technology capabilities to make the shift. Shonali?
And we're going to stay on earnings here because Pfizer's stock up pre-market after reporting better than expected earnings before the bell. The pharma giant also boosting its full-year forecast. Here with more is Bloomberg Health reporter Robert Langreth. And it's really the first shot across the bow here from Pfizer as they look to fend off an activist investor in Starboard. But you still have really a significant plunge from that 2021 peak in Pfizer shares. How does this first forecast boost really start to help them, if at all, against this activist battle?
Well, this is certainly, some good news that they needed to buy them some time. The guidance raise and the earnings beat, a lot of that, and the revenue beat, a lot of that was driven by the COVID drug Paxlovid. Those sales went through the roof. They had $2.7 billion of Paxlovid sales this quarter. And last year at this time, there were 0 sales in the U.S. That went up. Most of those sales were U.S. sales of Paxlovid. So it's a lot of this revenue raise is due to the strong Paxlovid sales, and the prospects obviously for that is uncertain. The critique that the Starboard Value is given is related to what have you done since the pandemic, and all these deals that you've done, did you overpay and not get enough return for that? So this is going to play out over a while, and it's just not clear what's going to happen.
Well, to focus on the results a little bit more, as you point out, I mean, a lot of this came from Paxlovid and an uptick there. It's certainly a nice surprise, but judging by the stock reaction, reading through some of the sell-side notes, it doesn't seem like Wall Street and, of course, traders are convinced that that's sustainable. Yeah, well, I think,
Wall Street and analysts and investment community is looking for what can you do outside of the the COVID franchise? And the beat this quarter, appears to be primarily driven by just the kind of massive sales of Paxlovid, and also the COVID vaccine came in a little above expectations too. So they're still looking for all the deals that Pfizer has done. Which is the biggest one is Seagen, which is a cancer drug company they bought for $43 billion. Wall Street is still looking to what kind of returns are you going to get from that? And it's still early days for that. And that's where the debate with the activists is going to play out. Is what kind of returns are you going to get from these big deals you've done?
So they spent a ton of money. They have little to show for it. They don't have a viable GLP-1. Doesn't Starboard's approach make sense to you?
Well, I'm not an activist expert, so I can't, comment on
Well, let's put it this way, Bob. Let's put it this way, Bob. Could Bourla or someone to replace him do a lot better?
Yeah, I mean, definitely, they need to show some returns. Wall Street wants some returns, outside of COVID, some big blockbusters that aren't COVID. And the big thing before, a couple of years ago was going to be obesity and obesity pills, and they made kind of big promises about that. And so far, those have not come to fruition. And they've had several setbacks on developing obesity pills. Now they're still working on that. That may still happen. But now the big focus is cancer, on this cancer deal. And so far, the biggest drugs in the cancer deal are still much smaller than, for example, the revenues they got from COVID this quarter. So. I'm not sure how much, long term this is going to change things, but we'll wait and see, what the market does when it opens.
Yeah, plenty to prove for Bourla and for Pfizer. Shares currently higher by about 0.6% pre-market. Bob Langreth, Really appreciate your time. Meanwhile, coming up, Starbucks employees are being told to get back to the grind in the office or else. Social Climbers up next. This is Bloomberg.
Countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Boot Barn getting a licking after announcing its CEO will depart the company next month to become the CEO of Ross Stores. One TD Cowen analyst said that the departure was a major surprise. You can see that in shares pre-market down about 8%. Next up, we have Crocs tempering its full-year revenue guidance because of weakness in its Hey Dude brand. Hey Dude is the lightweight slip-on loafer brand that Crocs bought for $2.5 billion 2 years ago. Crocs sales growth in the third quarter, which includes the crucial back-to-school shopping period, remained flat. And finally, we have Starbucks telling its corporate employees that they could be fired if they don't come to work at the office 3 days a week. According to an internal memo, Starbucks will start to hold workers accountable if they don't abide to return to office policy. This comes less than 2 months since Brian Niccol took over as CEO, Matt. So get back to the office, but just 3 days a week.
Yeah, that doesn't seem too difficult. I've actually never worked a day from home. Have you ever worked from home?
No, not even during the pandemic, actually. But, you know, I do understand why this could be difficult for some people. It at least changes the base of talent that people are looking at. But, you know, when you work in the in-store chains, it's a lot more difficult.
Well, also when the CEO comes in and says, as long as you can do your job, I don't care where you are, then you make plans to do it from where you've been doing it. And then when they change the rules a couple months later.
When they change the CEO a couple months later.
Yeah. All right, coming up, less than 4 minutes to go until the opening bell. We'll discuss the market moves with Gabby Santos at JP Morgan. This is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
We are moments away from the start of trading and 1 week away from the U.S. presidential election. This is Bloomberg Open Interest. I'm Matt Miller. You can see that we have a little bit of a mixed picture in terms of futures. We were up yesterday. We're really waiting for the big earnings to deliver after the bell. Google comes out as the first of the Mag 7 stocks to report. In fact, this week we have 42% of the entire S&P 500 market cap reporting. You hear the opening bell on the New York Stock Exchange. Paramount Group ringing the bell there. Down at the NASDAQ market site, we have Plug Power. A couple of companies that have been in the spotlight over the last few months, but we're really worried about the big ones, Katie. We're really looking forward to Google after the bell to, I guess, it's not going to drive today's market, but really the rest of the week.
It'll give us something to talk about tomorrow, because at least for right now, not much to say. You can see the S&P 500 off by about 0.2%. We're really hanging out sort of unchanged on the NASDAQ 100, 0.1% higher if you're an optimist. Of course, all the fireworks coming after the bell, and then the days ahead, things are busy. You can see the small caps, though, a definite move there. The Russell 2000 currently lower to the tune of about 0.7%. Meanwhile, let's take a look under the hood. We do have some action, and that is in DJT. We are talking about Trump media and technology shares extending gains again. No real news here. This is just a proxy, of course, on Donald Trump's election odds. It's an unprofitable company, but this big boost that we've seen, finally the company is crossing the $9 billion mark, share soaring alongside those implied odds in the betting market. Shonali.
Watching some key earnings movers as well over here. I'm looking at PayPal. People souring on the financials today a little bit. PayPal's down after providing a Q4 revenue growth forecast that disappointed, but posted third quarter profit that beat estimates. It's down about 6%. D.R. Horton, that's down almost 14% as the market opens, reporting weaker than expected home orders. High mortgage rates are straining buyers struggling with affordability. And we're watching the owner of Vans also climbing after results surprise on the upside. It is just surging, up almost 19%. Matt, isn't there someone you know associated with this that you think is part of this move?
Yeah, I was going to. I've been telling people today about Jeff Spicoli, and I can't believe that no one on this desk has ever heard of the man. Sean Penn played him in Fast Times at Ridgemont High. He really made Vans famous. Here you see a bunch of stock moves. Do we not have a picture of Jeff Spicoli? I feel like...
I don't think so. But, I mean, we do have that move. It was up 20% at one point, now up about 18%. That is the biggest one-day jump since 1987.
Incredible. So. That is some size and scope there.
The movie's from '82.
Wow.
You really should put it on your list.
I'm going to pass on that.
Okay. Let's check in finally on shares of another van maker, Ford. The car maker cautioned that full-year earnings will be at the low end of the forecast. We want to discuss this with Bloomberg's Keith Naughton, who almost certainly has seen Fast Times at Ridgemont High. I think really...
I definitely remember Jeff Spicoli, Matt.
Thank you very much. People of a certain age. Let's take a look at what's going on with Ford. It doesn't seem like they can catch a break. Now they're lowering their guidance for the full year. Is this the bottom? Can they turn it around from here, Keith?
They certainly hope so. You know, Farley is the CEO, Jim Farley, is very frustrated over these persistent, stubborn warranty costs that really are weighing on Ford's profits. You know, like General Motors and others, they benefit from this incredibly high pricing that's out there on cars right now, but it isn't, you know, giving them as much of a lift as their rivals because they have these high costs to repair their cars. They are the most recalled automaker.
Well, to that end also, how much downside really is there to Ford? Because, you know, we were just talking about this really just a day ago, I believe, Keith, and this issue has been pretty tough for them throughout the majority of this year. They've been pretty sideways since that plunge you saw in the middle of the year.
That's right. So, they had the big surprise back in July when warranty costs were $800 million more than they expected. They said that they actually improved them a bit in the third quarter, but not enough. And so, the last plunge in the stock in July was an 18% plunge. We're down about 6% now. It's not quite as bad as that route, but still pretty bad.
Still pretty bad. You add it all together, Ford shares now down over 11% year to date on a total return basis. And let's compare and contrast to what we learned from some of Ford's rivals in the past few weeks, because you think about Tesla, you think about GM really delivering in this environment where it seems like Ford can't.
Yeah, I mean, GM raised its earnings forecast for the third time this year last week. And then you saw Tesla. They delivered in their traditional car business. So we're not talking about robo-taxis or AI. They just sold more EVs than expected, and their stock soared. So along comes Ford, and it's a completely different story, and they're really being punished for that. They need to get their costs in line, and that's what's holding them back at the moment.
All right, Keith, great to speak with you. That is Keith Naughton in Detroit reporting on Ford. And Jeff Spicoli, that's his name?
That's right. Thank you for remembering.
Apparently, according to the internet, he's a stoner surfer dude, so I'm going to file that one away. But let's broaden out the conversation now with JP Morgan U.S. Chief Market Strategist Gabriela Santos. It's great to see you in person again.
Good to see you. Thank you.
There are so many cross currents in this market, particularly at this exact moment, from the Fed, the election, earnings, the economic data. When you look out to the future, what is the true signal that you are following right now?
So I do think the skies are
Morning, he's going to come on the program a little bit later from TKNG Capital. And I said, hey, Neil, we're growing at 3.5%. And he said, sure, we're spending, 10% of GDP in deficits. I mean, if we continue this deficit-fueled spending, the economy's going to be fine until it isn't.
So I think what's interesting about the deficit, it's at nearly 6.5% of GDP. It really shouldn't be this high on a non-recessionary economy. But if you think about whether it's stimulative or inflationary, actually not so much at this point, because a lot of it is being driven by interest payments. But I think the discussion is what happens at the end of next year around the expiring individual tax cuts and potentially additional tax cuts and additional spending. So yes, I think we've gone from an era where fiscal policy was very much focused on austerity and was a bit of a drag on growth, and so it was all about the Fed and lower rates, to now it being more of an era with elevated deficits and more fiscal activism. And that means the Fed can take a bit of a backseat, but it also means steeper curves, more anchored at a higher level long-term yields.
There's much more where that came from, but because we are in the thick of earnings season as well, you asked this question in your notes, this idea of when it comes to that CapEx spend that you're talking about, that expectations for AI revenue, how much of that is already baked into the pricing here? How much of that is really allowing for more upside at this juncture?
So, of course, really critical week for that structural theme of AI spend with 5 out of the 7 of the Mag 7. So I do think the first is just the AI CapEx spend itself, that every quarter, once these companies report, we keep revising it upwards. So exactly how much are estimates of 30% annualized growth for the next decade actually too low? Maybe it's even higher than that. How healthy is that CapEx spend? And right now, actually, the market's been okay with it because it's been stable as a percentage of free cash flow. And then lastly, who benefits? And I think the big theme of the last 2 quarters has been a broadening of the beneficiaries of that CapEx spend into utilities and industrials, which we should look at in terms of earnings reports. And then the last bit is actual revenue generation with AI. And that's where I think there has been a little bit more scrutiny around how much have we pulled forward in that expectation, how much is it nice to have versus truly moving the needle.
Yeah, and that definitely was the narrative of the last round of earnings. I want to dig into that point, though, that you made about the health of that spend, because I haven't heard that before. What is healthy, what is unhealthy, and how do you define that?
So I do think if we think back to 2022, when we had a correction, a pretty big correction within the tech sector, that was investors looking at the kind of CapEx spend that tech companies were doing and saying, look, this isn't likely to generate higher cash flows, revenues, earnings in the very near future. We're going to punish you for that kind of CapEx spend. And really a lot of late 2022-23 was reorienting towards more value-add kind of CapEx investment, which is now this whole AI and AI adoption theme. And when you do, you can measure it a few different ways. For example, CapEx spend as a % of free cash flow. And it has been stable over the last 2 years, meaning companies are spending $200 billion on AI, but they're also generating $200 billion worth of more free cash flow. And so in that perspective, it is healthier amount of CapEx spending versus the metaverse and
So it's just the
other
return,
years.
necessarily.
The kind of cash flow you're already generating for it versus the promise of it very late into the future if it happens.
I haven't heard the metaverse in a while.
No.
Well, remember that? Remember
You keep
that?
calling it Facebook still.
Facebook, yeah, well, I mean, it is Facebook, right?
It is Meta.
Yeah, but how much, what are they driving with their Meta business?
That's what
just
exactly.
losses,
That's
right?
what
Yeah,
Gavin's
yeah.
saying.
I know. I just want to quickly talk. Gold has just hit another all-time high. I'm looking at Bitcoin right now trading at $71,500. Are we expecting an inflection in inflation? I mean, are these assets telling us, or at least warning us, of the potential of inflation to come back?
So it's been interesting to me that we've seen a rise in gold. Perhaps we could have Bitcoin, but long-term yields, the 10-year has risen the most in nearly a year and a half.
Right, and I think of Shanali's interview with Druckenmiller. I think of Paul Tudor Jones was on CNBC warning about this and saying that he's buying these assets.
I think in the moment, we continue expecting disinflation, and inflation expectations are still doing all right despite these moves. But what I think investors are aware of is that we may be in for a period of more inflation uncertainty, that 2022 was not a one-off. In the future, there can be another inflation shock. And we've been speaking to a lot of clients of preparing portfolios, not just for recession risks, where bonds do great, but also inflation shocks. And in that case, gold is something that stands out, as well as within alternatives, things like real assets. So I think that's not so much a short-term story about inflation and fiscal stimulus, but it's more of a question about
Not
preparing
Bitcoin, though,
portfolios.
Right? How many decades is
really
Bitcoin going to have to run higher before plain vanilla, before regular strategists say, oh, I like it as an asset?
It's just that you can't quite understand its role in portfolio construction. Like, does it do well when inflation goes up or rates go up or recession, or it's just a bit more unpredictable in its role.
Yeah.
And so when it comes to actually sizing it or thinking about how it fits, it's a bit hard still.
It is the purest measure of risk appetite.
Yeah.
That's how I view it, at least.
Yeah. Or DJT right now, which is halted again, it looks like, after surging another, well, that's a whole other story. Anyways, JP Morgan's Gabriela Santos, we thank you so very much for your time. We're going to get back to earnings season next. Coming up, we're going to talk about McDonald's missing estimates in the third quarter. And it's because of sales outside the United States, but of course, containment on the E. coli outbreak. We're going to talk about the outlook next. This is Bloomberg.
In tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
And over in earnings news, McDonald's reporting comparable sales that missed expectations amid weakness in international markets such as France, China, the UK, and the Middle East. But remember that it's also dealing with the deadly E. coli outbreak in the United States that it says is contained. We're going to break it down with Bloomberg Intelligence senior analyst Michael Halen, because you are seeing a little bit of a lift there in McDonald's stock, but it's really flat on the year because the issues that they've faced internationally have been plaguing it all year long. But when we think about the current set of problems that McDonald's is facing, you know, what are they really saying about the outbreak and their ability to get beyond it?
Yeah, they think they've contained it from here on out, for sure. You know, we think there's still a little bit of risk to the story. We don't think all of the cases have been reported yet, and so as those roll through, we think there's still some you know, headline risk. We also, you know, expect consumers to be skittish about, you know, jumping right back into ordering quarter pounders with cheese at their local Big Macs, right? And so, you know, we expect the fourth quarter sales to be impacted, and we expect, you know, some of it to kind of spill over into the first quarter. You know, it's the timing of it was kind of stinks for McDonald's. I mean, they had just kind of gotten their footing for the first time this year. They said same-store sales were up mid-single digits for the first 3 weeks of October, and I think that's why you're seeing the shares up very slightly today. You know, Chicken Big Mac and the $5 value meal and some of those things had started to give them a little bit momentum. They said they've attracted some low-income consumers for the first time this year. But, you know, data from Bloomberg's second measure show that same-store sales were down about 9% last week. And so that's kind of wiped out any of the gains they've had for October. So
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
There's no question the deal-making environment is improving. And when you look at what's going on with technology, and the investment that's necessary, to power AI, I think that's a tailwind for deal making over a period of time too. A lot of change, a lot of opportunity.
And that was Goldman Sachs CEO David Solomon speaking at the Future Investment Initiative Conference in Saudi Arabia. That conference is the focus of today's Wall Street Beat. We head now to Riyadh, where we are joined by Bloomberg's Jomana Berteschi. And we look at your interview, but you made this great point in the story you wrote as well about how Goldman has opened an office in the Saudi capital here, a new office. And then you also think about the fundraising landscape around the world, this idea that, yes, it's been hard to come by fresh capital, but the Middle East has actually been a prime source of financing this year. What are you hearing on the ground about the business opportunity?
Yeah, it's great to chat to you, Sonali, and I know that you know the story of Goldman better than anyone, but it was interesting to speak to David Solomon earlier today, and they have had a presence in the region, in the Middle East region, for a really long time. He was actually saying that this, I think, is the 6th or 7th FIA conference that he's attended. But the big news this morning is that they are one of the first Wall Street banks to announce that they're opening up a brand new office in this new Riyadh financial district. They were also the first Wall Street bank to apply for this regional HQ license that the Saudi government has been offering. So far, there has been good take-up, but Goldman definitely one of the first to get involved there. But what they say is essentially they do see the region as a hotspot in terms of deal-making and activity, and that also ties into the broader conversation we were having. You played a little bit of sound there about how he sees the future of deal-making, and he says back on their earnings call, they mentioned that they had a decent M&A backlog that they look to work through. They're positive about the future of deal-making. That being said, their one concern is potential regulatory headwinds, and he also alluded to perhaps a change maybe in regulatory oversight once the elections are out of the way. But generally speaking, he was very positive, specifically also on the status of the U.S. economy.
All right, Jomana, great to get a take from you, even if it's short, and I hope we can have you back on this program as soon as possible. Bloomberg's Jomana Berteschi there at the IFF in Saudi Arabia. Coming up in the next hour, Citizens Financial CEO Bruce Van Saun joins us on the state of the banking industry and his post-election expectations for his company. And Neil Grossman, my old buddy Neil Grossman from TKNG Capital and the Norges Bank, is going to come on here and tell us his take on the Fed and inflation, as well as deficits. Definitely an interview you don't want to miss. This is Bloomberg.
First of all, global trade, which had adverse consequences that we're learning about to this day, still unleashed an enormous amount of gain for humanity. And with the rise of global trade became the rise of information sharing around the world, which rapidly accelerated the trajectory of mankind. I mean, of note, the Chinese, for example, are leaders in solar. They're leaders in EVs. They're leaders in a number of emerging technologies. In a world which is more splintered, we'll see the gains that the Chinese have achieved in these important areas not shared by the Western countries. And conversely, the United States is a clear leader in AI, along with a number of the European countries. And those gains will not be shared with China and the countries in its sphere of influence. So it's a very clear-cut loss for all of humanity when we have the severing of ties between our countries.
On a practical level, is it getting harder to manage the risks you face?
I think that one has to be aware that there are more tail risks that are harder to ultimately manage. DOJ or other authorities
could face bigger challenges next.
It was going to keep rain World Cup. This is a three
As the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
This is CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. 7 days to go until the election, and the presidential candidates are barnstorming battleground states. We begin with former President Donald Trump's campaign and CBS's Libby Cathy.
Before he is in Allentown today, he has a stop in Drexel Hill in Pennsylvania, and he's holding press availability at his beach club in Mar-a-Lago this morning. That, we believe, is to counter what we'll hear from Vice President Kamala Harris tonight, her closing message on the ellipse.
That's where Mr. Trump spoke hours before the attack on the U.S. Capitol. UVA political analyst Larry Sabato.
They clearly wanted to remind people of the threat from Donald Trump. If he did that 4 years ago in his first term, what will he do in a second?
People in Minneapolis want to know why it took officials almost a week to arrest a man accused of shooting and wounding his neighbor, months after John Sawchak was caught on video harassing the victim. CBS's Jared Hill.
The police department is facing backlash for not acting sooner.
We failed this victim 100% because that should not have happened to him. The Minneapolis police somehow did not act urgently enough to prevent that individual from being shot.
Sawchak is scheduled to appear in court later today.
Feel like you're getting more robocalls than ever? It's no wonder. CBS's Nancy Chen on a new consumer watchdog report that finds a lot of companies aren't in compliance with a new federal law.
Nearly 4,000 phone companies have installed anti-robocall technology in the last 3 years, but the report says only 47% have fully completed those measures.
McDonald's can thank value meals for turning around U.S. sales in the third quarter.
1, 2, 3.
The chain has beaten analysts' expectations with same-store sales up 0.3% as Americans looked for bargains amid skyrocketing prices. But the $5 meal may not be enough to save McDonald's from fourth quarter earnings and fallout from this month's E. coli outbreak linked to raw onions on its quarter pounders. Yankees fans have been leaving offerings like baseballs and sunflower seeds at Babe Ruth's grave, hoping it'll bring the Bombers back from the brink of elimination. Tonight's Game 4 of the World Series is a must-win with the Dodgers up 3-0. Yankees manager Aaron Boone.
Hopefully we can, go be this amazing story and shock the world. But right now it's about trying to get a lead, trying to grab a game and force another one and then on from there. But we got to grab one first.
No team in MLB history's ever come back from a deficit like that. This is CBS News.
is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube as well, so check us out there. Go search Bloomberg Podcast. That's where you'll find us. Alex Steele out today. Not to worry, just met and sitting in.
That's right.
Big
so
earnings
exciting.
day.
It is. We're going to have big tech all week, but we do have some individual movers we're going to get into with Carmen Reineke in a little bit.
We're going to do that in just a moment. We've also got some economic data we're going to break down. We had some consumer confidence numbers came in way better than expected.
That's
JOLTS
right.
numbers coming in well below expectations. So we're going to break all that down. We've got Ira Jersey's going to join us from Bloomberg Intelligence. Neil Grossman in studio. He's a co-founder and former CIO of K&G Capital, one of the smarter voices we talk to about markets broadly defined. Mike Kalin's going to join us here. He covers all the restaurants for Bloomberg Intelligence. McDonald's, I think the quarter pounder's back. I'm not sure if the onions are coming with it.
I know.
But I'm a number 2 guy with a Coke. That's been my order since I was like 14. That's a quarter
So
pounder.
I've always been about Whataburger because I'm from Texas.
Whataburger.
So that's right. But I like the number 5. It has the bacon and cheese.
Okay, that's how you go. Are you coming back? McDonald's is coming back. They're not going anywhere. All right, let's kick everything off here with John Tucker of Bloomberg Business Flash. John, what do you have first?
All right, guys, the report being brought to you by Interactive Brokers Portfolio Analysts. Consolidate and analyze all your financial accounts on one powerful dashboard for free. Sign up for Portfolio Analyst at ibkr.com/freepa. We are data dependent, so let's get you the data. Job openings falling in September to the lowest since early 2021. Also, layoffs picked up, consistent with the slowdown in the labor market. This all coming from the job opening labor turnover survey that we just got. As you mentioned, Paul, consumer confidence way off the charts. Everybody's confident, apparently. Better than expected there. We'll break it down in just a minute. S&P 500 right now, only 3 of the 11 major industry groups are higher. Information technology is in the lead. And, of course, after the close of regular trading in New York today, we'll get the results from the first of the 5 of the Magnificent 7 cohorts that are reporting this week, the busiest week for earnings so far this quarter. We get Google parent Alphabet. And Ford Motor Company shares falling. The company warning earnings this year are going to be the low end of its forecast. Bitcoin, we'll do that for you, rising past 71,000 for the first time since June, bolstered in big part by inflows into the dedicated exchange-traded funds there. S&P 500 down, well, let's call it unchanged. 58.22 right now, the Dow Jones Industrial Average, and that's where you find McDonald's. Right now, down 5 points, pairing some of the earlier losses, and the NASDAQ 100, that is up 30 points, up 0.1%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, that's your Bloomberg Business Flash. Hi, Jess and Paul.
All right, John Tucker, thank you so much. We appreciate that. Jess Minton sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. As John was just reporting, consumer confidence data came out, 108.7. The consensus was 99.5. Prior period was revised up to 99.2, so a big jump here relative to expectations in the last period. Let's break it down, Jess. We check in with Dana Peterson, chief economist at the Conference Board. Dana, put this number into context for us. It seems certainly really good relative to what the market was expecting.
Yes, definitely. Consumers were on the whole pretty happy in October. Certainly, they think the present situation is better, and also expectations, and notably expectations for jobs were positive for the first time in almost a year and a half.
Oh.
So there's really good news out there.
So what do you think this means as far as the direction of the economy here?
Well, the U.S. economy has been doing quite well, and indeed, consumers have been driving it. We saw in the tracking data from retail sales and also from the BEA that consumers are buying goods, they're buying services, and that's certainly supporting growth. And we're seeing that finally show up in confidence. Indeed, consumers were getting a little bit worried about the labor market over the summer, but then we had those blockbuster payrolls numbers. Most consumers are seeing their incomes rise because wages are elevated. Most consumers are working. We are seeing a little bit of layoffs here and there, but again, the predominant sense among consumers, at least for this month, is that they're okay.
How much, Dana, do you think is impacted at all by the Fed cutting rates? Does that come into your calculation here?
Absolutely. We have one question where we ask about interest rate expectations, and that measure actually ticked up. And we do have items where consumers said that they're not as convinced that rates are going to come off. But then we did see some who were saying, look, the Fed has cut interest rates. We're seeing a little bit of improvement in. But consumers are starting to get out there and buy big ticket items because they're cheaper, not so much because interest rates are lower, but as interest rates fall, we think they'll buy more cars and furniture, things that they need to finance.
All right, some pretty solid numbers. I also know the Conference Board expectations data point came in at 89.1. That's versus revised 82.8 from last month. So also in terms of expectations, better than expected. Dana Peterson, thanks so much for joining us. Dana Peterson, Chief Economist at the Conference Board. Looking at the markets, markets kind of digesting what's going on out there. Really no real movement in the indexes.
But we also had the jobs, the JOLTS opening.
Yeah,
we were looking at that data. So it actually came in missing expectations there. But it's interesting if you're looking at the yield space, what's happening with the 10-year, trading around 4.3 right now. But looking at yields falling lower here after the jobs openings, fell far more than expected. So that does imply that the U.S. labor market may be a bit weaker than expected, but still it's important to watch those revisions, obviously, with the next jobs data.
Yep, so the JOLTS came in at 7.443 million. It was looking for 8 million was the job opening, so fewer job openings, a little bit tighter market out there, so we'll keep an eye on that. Let's check in with Carmen Reineke. She covers all the equity markets for Bloomberg News. She's here in our Bloomberg studio here in New York City. Carmen, what do you see in some of the individual names out there? I know a lot of earnings activity out there today.
Yeah, well, the first one I'd love to talk about is sort of a tale of two different shoe companies. So we're looking at Crocs, ticker CROX, and VF Corp is ticker VFC. So Crocs is down about 19% right now. This is the worst drop since April 27th. The company lowered its sales outlook and specifically warned of declines in its Hey Dude brand. This is a brand that's I think kind of dragged down the casual clog footwear company. So it sees its full year sales falling nearly 15% from a year ago. That's specifically for the Hey Dude brand, and this compares to a previous guidance of a drop from 8% to 10%.
I can Google this, so keep
talking.
Yeah,
VF Corp, it's like Vans, North Face, Timberland, so a little bit of a different on the other story there.
This is the flip side of the coin. So shares of VF Corp are up 28% right now. It's on track for the best jump maybe ever, at least since 1980, where our data goes back to. Yeah, so basically this report showed that the sort of transformation that VF Corp has been going through is paying off. The company it brought in revenue that beat analyst expectations, and it also said that it paid down debt in the last quarter. Basically, following the sale of a Supreme brand earlier this month, it paid down some of its $1 billion term loan due in December. So mostly just it's looking better for VF Corp going forward.
So Carmen's one of our star tech reporters on our equities team. So she's been covering all things leading up to whenever we talk so much about the big tech earnings. I know we're going to have Alphabet after the closing bell today. It's supposed to be on track for its 6th straight quarter of double-digit adjusted profit growth. What do you think we should expect when it comes to companies like Alphabet and then the remainder of the big tech that are coming later this week?
Yeah, I mean, I think the thing that's so interesting when you look at the Magnificent Seven, especially their stocks right now, there's been kind of a difference in like the outperformers and the underperformers. And Alphabet's stock has sort of been underperforming. You know, we have a great piece out from Ryan Vlastelica, my colleague today, showing that Tuesday's results, you know, they probably aren't going to move the needle a ton on these concerns. I think the thing that we're looking at for a lot of these companies is AI spend. CapEx is projected to be, you know, a record in this quarter, but it's going to be very different, I think, individual company-wise in terms of the stocks. So.
All right, Carmen, thank you so much. As always, Carmen Reineke.
Great stuff.
She covers all the equity markets for Bloomberg News, joining us here in our Bloomberg Interactive Broker Studio. Again, a lot of economic data here today, a lot of stuff for the Fed to chew on. We're going to get some jobs data later on this week. Let's check in with Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. Ira, it looks like consumer confidence today. Those numbers look pretty solid. The job market may be a little bit tighter here. What do you think the Fed's looking at these days in terms of getting a gauge of maybe how they need to be behaving over the next several meetings?
Well, I think the job market is clearly their focus, and the whole reason why they cut interest rates 50 basis points at the last meeting. When I look at the consumer confidence data, they've basically been chopping around in the mid 90s to the low teens in terms of 112 to kind of 90, 95ish on the consumer confidence number. So it's been very volatile in this range for the last several quarters. So I wouldn't take a lot out of the confidence numbers, but those JOLTS numbers are interesting because I think from the Fed's perspective, as the job market gets back into quote unquote better balance, you see job openings obviously falling, and it's not necessarily because more people are getting employed, although that's part of it, but it's also just that businesses aren't necessarily expanding and the like. So I think that the Fed is still going to lean a little bit dovish. Now, I think they're going to cut, but I suspect that, given all of the data that we've had, including today's data, that it means that Jay Powell is likely to say, leave open the idea of skipping a cut in December. And I think part of that is just going to be like, hey, if the data continues to be as robust as it is, we can cut more slowly. And that's how he'll kind of couch that argument.
And to your point, looking at the U.S. job openings data declining to the lowest level since early 2021, obviously you're pointing out the next Fed decision on November 7th. So since we
GDP numbers and the personal spending numbers from September. It's a little bit on the older side, but at the same time, the PCE, headline PCE is what the Federal Reserve targets. So that's why, the pace of those and where the third quarter data ends up is going to be at least somewhat impactful as to how the Federal Reserve.
I wanted to ask you about the third quarter data because the Atlanta Fed GDP Now model still has the third quarter GDP at 3.3%. I mean, that's very strong growth. And so when people are trying to make calls about economic growth slowing or these kind of recessionary calls, clearly, I know to your point, that is backward looking when you're looking at some of these numbers. But even the ECFC function in the terminal, you don't really see a contraction even on a quarterly basis year over year in that. So where do you think, where are the weakest points, do you think, in the economy? Or what do you think, like, when you're looking at the bond market, what is that telling us?
Well, the bond market's certainly saying that we're not in a recession or headed there very quickly. We've now priced out around 80 basis points worth of interest rate cuts by the Fed. So you go back to mid-September, and we were pricing for the Federal Reserve to cut all the way down to below 3%, and now we're priced for around 3.6%. So we're talking about the Federal Reserve cutting another 100 to 125 basis points and then be done. That is at this point, given the data, that has to be a realistic outcome and is a growingly realistic outcome, I think, because keep in mind, one of the reasons why businesses are still, adding people and the like is because the consumer has been strong. And one of the important pieces of data, and we put this out in a piece actually that came out today, is going to be that personal spending data that comes out on Thursday.
All right, we'll pay attention to that because you tell us to, so we'll do that. Some good stuff there. We appreciate our average Jersey Bloomberg Intelligence Chief U.S. interest rate strategist giving us the laydown on some of this economic data. We're going to have more coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Major stock averages, they are mixed to little change at this point. In the S&P 500, you have 8 of the 11 major industry groups lower. Biggest drags coming from utilities and consumer discretionary. D.R. Horton, the worst performing stock right now, the S&P 500, down close to 13%. The share is falling the most in more than 4 years. The home builder reporting disappointing results for its fiscal fourth quarter. And then the data, the job openings falling in September to the lowest since early 2021. This is the data from the job opening and labor turnover survey that we just got. And then there's from the Conference Board, the consumer confidence increasing in October to the highest level since the start of the year. S&P 500, 2 points higher, 58.25 in the index. The Dow Jones Industrial Average up 22 points. And right now, the NASDAQ 100 up 60 points. That's a rise of 0.3%. The yields, 2-year, is right now at 4.13, little change. The 10-year yield, 2 basis points higher, and that is at 4.30. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Jess and Paul.
All right, John Tucker, thank you so much. We appreciate that. Jess Menton sitting in for Alex Steele today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube as well, youtube.com. Head there, search Bloomberg Podcast or Bloomberg Live Radio. That's where you'll find us. Speaking of YouTube, what would you like to hear on Bloomberg Radio? Help make shows like ours even better by taking our Bloomberg Audience Survey. Visit youtube.com/Bloomberg Podcasts. And click the link in our profile or community section to take the survey, which is hosted by our partners over at Material. Fill it out now at youtube.com/Bloomberg Podcast. Our next guest, this is how it's going to work, folks. I'm going to ask a question, and I'm going to turn off my mic, and John and I are going to sit here and listen and try to get a little bit smarter.
And take notes.
Neil Grossman, he's a co-founder and former CIO of KNG Capital, joins us here in our Bloomberg Interactive Broker studio. We're in a suit today. I can't remember the last time I saw you in a suit. Neil, we got a lot of economic data. We got right smack in the middle of earnings. All that's important. But I think since we have you here, I would just love to get your opinions about how you think the markets are digesting a pretty big election next Tuesday. Are you, when you talk to clients, are you saying, hey, if Trump wins, think this? If Harris wins, think that? How are you kind of positioning all that?
Well, I think there's 2 levels to this. Oh, by the way, thank you very much for having me. It's a pleasure as always. At least as a start, both of the platforms seem to be talking about spending a lot of money. So the first question is, what's the impact of that on the economy, on the Fed, and then you can try and maybe zero in on what the theoretical differences are between the two. Look, if you look at the economy and where we are and where we've been, I would look at the July and September Fed meetings and just scratch my head. We had functionally 2 fairly weak, or one fairly weak and one moderate job numbers that propelled the Fed to what looked to me like they were panicking. And it turned out, of course, with the revision that really wasn't the case. So I think where we find ourselves right now is a couple of things. One, the labor market is fine. There are going to be some real unusual impacts over the next number or 2 because of the Boeing strike and the hurricanes, which really affected a pretty significant part of the population. And I don't know how to read the employment numbers now, but I will tell you this. I think my daughter lives in St. Pete. If you go down to St. Petersburg and you drive, and the miles and the miles and the miles of people's lives have been destroyed but have to be rebuilt, there is an enormous amount of money that is going to be put to work in this economy. Forget the fact that we're running 8 or 9%, deficits, which is historically staggering. The biggest question you might ask yourself is, can they actually address the deficits without having a significant economic impact? Because to go from a deficit growth rate of 8 or 9 to back to traditional 3% probably will be a very difficult task.
I've heard candidates promising the world, and I don't know how they're going to fund it. Liz Truss kind of ran into the same problem. Where are the bond vigilantes in all this?
You're starting to see it a bit. Look, The yield curve, I mean, I think the last time we were on, we were talking about yield curve structure, and it's steepened a lot.
Yeah.
And I suspect that this is one of the problems what the Fed did. There was absolute panic in the way they did things. And I mean, this concept of recalibration, to me, it's an awful laughable word. It's going to be, recalibration is going to become the new transitory. You know, the bottom line is they don't really know what a neutral rate is, and they certainly don't know what a neutral rate is when we're spending money fiscally like it's rain. So if they really wanted to try and ease in and understand the impact, this would have been a very slow, elongated process watching. In the meantime, what happened? They not only cut 50, but they've sort of promised that they think you're going to be another 200 basis points in short order. And the first thing that happened, of course, is the yield curve has started to steepen like there's no tomorrow. If you really want to look at things, to me, you know, the Fed focuses on short rates, but at the end of the day, long-term interest rates are an indicator and a measure of what you should be expecting for long-term growth and how you manage, you know, the investment and capital allocation decisions. And I don't see any reason to think that if they keep cutting with liquidity already just beyond imagination, stocks at all-time highs, very high deficits. We're still at relatively low rates of unemployment. A lot of the wage settlements have been very large, by the way. I mean, the last one. And we have not seen most of the government workers, union workers, ask. Can you imagine? I mean, I think there are 25 million people employed by governments in this country, which is about 1 in 6. Can you imagine if those union workers are going to insist on the same nature of wage agreements going forward? I mean, this can't be handled.
So, but I mean, in terms of the deficits and the national debt, I started working on Wall Street in June of 1986. It was an issue then. It's still an issue.
Remember the national debt clock in Times
the
Square?
national debt
Yes,
clock.
it is. And do you know what the unfunded liabilities are? 200 to 300 trillion, which is, I mean, that dwarfs all the problems. Yes, and part of that is, look, Social Security is going to run out of money, trust fund, and then that will go on to the budget as well. So look, I don't know if there's time left to solve the problems or not. I don't think history teaches you that you can avoid reality. And our deficits relative to the nation's capacity are certainly causing the seams, or may cause the seams to burst. And, you know, the sooner you deal with a problem, the less you usually have to do to solve it, and the easier the transition.
But there's just no political. There's never, ever been any political will to deal with this.
Well, how do you look? I think something on the order of 65% of the working population pays no net taxes, and
they pay no net taxes.
Yes, when you look at all the benefits and add it all together, how do you tell people? And I have this discussion with a lot of people. I mean, how do you tell them that they can't? They're going to lose something. That's a very difficult thing to start with, and then you end up with these discussions about, well, your Social Security and Medicare, Medicaid need to be cut. And they said, well, I paid for this. I said, well, you really didn't pay for it when you look at the projections. The problem is you're relying on the future to continue to pay for your problem. And I don't know the answer to this. I think we've missed opportunity after opportunity to address it. And, you know. And
again, as John said, I don't hear either candidate talking about that.
Nobody
constructively.
Look, even the Republican, what's his name? McCarthy and Mike Johnson, both of them, when asked, every time they sit down to negotiate, the first thing they say are entitlements are sacrosanct, they won't be touched. That's functionally, I think the actual number is, we historically take in 18% of GDP and traditionally spend 21%. And by the way, that 18% is consistent across almost every tax regimen we've ever seen. But if you went back 20 years ago, 1/3 of government spending of that 18% was entitlements. We're beginning to push, I think we're very close to where almost every dollar coming into the government is going out in the form of entitlements. And we're not, you know, so the extra 8 or 9% or above that, or you know, actually I guess it's about 9% of incremental spending is all deficit funded. And it's going to be a very painful.
There was a time where you had bipartisan kind of consensus, like a committee, Simpson Bowles.
Simpson Bowles.
But I suspect that environment is long gone, though.
What was Phil Graham's partner's name in the same thing? Graham
Dodd?
Graham Dodd. Same thing. You know, that's the way. I mean, it's sort of kick it down and put it to some sort of under the counter committee, and hopefully you listen. But it doesn't. It doesn't
All right.
remain.
So given that dire backdrop, what do you do in the financing world? What do you do in the investing world? How do you think about it?
Yield curve. Number one, I believe, if the Fed is going to continue easing, the long end of the yield curve is going to be under pressure.
Okay.
How high it goes, that will be a function of inflation. I do think you're going to start to see inflation in ways you don't want to. For example, again, the southeastern issue, used car prices are already being pushed very high down there. Cost of construction materials going high. Probably labor costs are going up in those ways. So some of the broader pictures, that's not the whole United States, obviously, but there is likely to be cost of housing, by the way. So I think that there is a lot of risk that you are going to see higher inflation numbers over the next 6 to 18 months just from that. Now, was that going to be from a 2.25 and 2.5, or is it going to be from a 3, or is it 2? I don't know, but I suspect that the progress towards lower inflation is going to find itself struggling for the moment.
So what does the Fed do November 7th? Here, 2 days after the election, we probably won't know, who's the winner.
I suspect they have more room to say, look, the data since we talked about this has been well above expectations. We'll see what the problem is the employment data could be really weak.
Yeah.
And so they could say, look, that number is really bad, or they could say that number is sort of distorted by factors beyond our control. My suspicion is they're supposed to say that unless you see an inflation rate drop to 2% or below, and that includes a core rate which is still above 3, that say drops to 2.6 all of a sudden, I think they're supposed to say we need to, we've already had a significant impact, and other things being equal, we have time to take our time. I don't know if they feel that they can do that, because I think there are things like stock markets that they worry about more than other things.
And it's almost like they did set the expectations for
But that's the problem. They shouldn't be setting when they tell you they're data dependent. I guess you can laugh about it, but when they tell you they're data dependent and the data is up in opposition to what they thought it was going to be, that they're supposed to, take a step back and try and understand what they were doing. So I don't know what they do, but I suspect, given all the current data, that 9 months from now, whatever you thought the rates were going to be in the absence of a significant change, they're going to be higher than what you thought at the front end, and they're going to be higher than what you thought at the back end.
All right, Neil, great stuff as always. Neil Grossman, he's the co-founder, and he's a former CIO of KNG Capital, coming into our Bloomberg Interactive Broker Studio. Just give us some thoughts here as we parse out this market, this economic data. And again, we had some consumer confidence data today that came in much stronger than expected. Retail sales are holding up. Inflation's been coming down. The economy's kind of chugging along. What's the Fed to do come next week, February 7th? This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. With this Bloomberg Business Flash, we have 4 of the 11 major industry groups in the S&P 500. They are higher right now, being led by communication services, and the biggest drag that is coming from utilities. And ahead of their earnings, after the close of regular trading today, the parent of Google, Alphabet, those shares, they are right now up 1%. The slew of earnings today, we heard from McDonald's, despite sales somewhat disappointing because of pressure from international markets. Those shares right now, they are up 0.8%. By popular request, VF Corp, the apparel company that owns Vans and North Face brands, reporting quarterly revenue that beat Wall Street expectations. Those shares soaring. They were up as much as 29%. And then you have Crocs tumbling. They had a tempered revenue outlook. Those shares, they 4 points, 113.91. So that is a huge drop there for Crocs. Shares of Pfizer after their results down 1.7%, and JetBlue plunging. Those shares down 15.5%. And we check the market speed all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Jackson Paul.
You didn't want to do Boot Barn?
Oh, Boot Barn. I've never heard of Boot Barn.
Boot Barn?
Right. It has about a $4 billion
like a Texas
market
company?
cap. BOOT is the ticker symbol on this. So it's actually down 20%, worst day since March 2020. So what happened here, the company did announce that its CEO, Jim Conroy, would depart from the company on November 22nd, and he's set to become the CEO of Ross Stores. So rival there. So you're seeing that stock pressure. But also that stock, to put into context for Boot Barn, close to 70% higher this year. So it was on a pretty big tear.
Like cowboy boots?
Yeah. The company sells boots, jeans, shirts,
Yeah.
hats, belts, jewelry, and other products.
Yeehaw!
Yeah. Yeah, Shonali Basket was just on TV talking about she wanted some like rose-colored boots from Boot Barn.
Very good.
The rattlesnake skin boots.
Yeah,
Ooh,
you can do that.
I like that.
Pretty solid. Cruising around the Jersey Shore.
Looks great in New Jersey, sure.
Yeah, exactly.
Sweeney Compound.
All right, John Tucker, thank you so much. We appreciate that. Just met sitting in for Alex Steele here today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. Earnings day, big earnings day. It's a big earnings week, actually, coming up. A lot of tech names. We'll keep an eye on that. The story of the morning is, I think, kind of just from an earnings perspective, is been McDonald's. It's been in the news a lot recently with the E. coli breakout. E. coli? Yeah, E. coli breakout. Anyway, stock put out some numbers today. I thought they were okay, but some international weakness. Same-store sales still negative. That's a challenge for them as they try to build traffic there again. This quarter does not include some of the concerns that they've seen over the recent weeks. Michael Halen joins us, senior restaurant and food service analyst for Bloomberg Intelligence. Hey, Mike, what did you make from McDonald's in the latest quarter? And then maybe more importantly, what is management saying about kind of what they expect their fourth quarter traffic to look like?
Yeah, unfortunately, they didn't give us too much information about the fourth quarter. I'd say the biggest takeaway from this call, and the reason why the stock is up right now, although it's not knocking the cover off the ball, is the fact that their initiatives, including the $5 value meal bundle, the $5 meal deal, I should say, the Chicken Big Mac, and some of the other initiatives, better operations, had actually led to a mid-single-digit same-store sales increase and positive traffic for the first 3 weeks of October. And so the street's kind of taking that as a positive right now. In terms of the fourth quarter, it was, they didn't give us much information. We did get a nice report from Bloomberg's second measure data yesterday that showed same-store sales were down I think people are going to be turned off from McDonald's. I think it'll probably spread a little bit into the first. I think people are going to be turned off from McDonald's. I think it'll probably spread a little bit into the first quarter next year. But McDonald's is working hard to get those U.S. same store sales kind of back on the right track. It's going to be a